The Fed is telling us that inflation is still a problem. It's going to be less rate cuts relative to what the market was expecting.
I think the Fed have been really clear that they're looking for progress on inflation.
Not only has the market moved away from a Fed cut in June, the market's not even fully pricing in the cut in July.
Actually taking no action right now is probably the best course of action for them to take instead of making a mistake.
They want to give the market what it wants in the form of easier policy, but the risk is overdoing it to the downside.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Your equity market facing just a little bit of trouble in the last couple of days. The bond market sell-off continues, closing out Q1 with a 10-year yield very close to 4.20, 3 days into Q2, and we're looking at 4.40 on a 10-year.
And suddenly stocks are waking up to this, and I think that was what we saw yesterday. Although, just to put into perspective, we were down 0.7%, which was the worst loss going back 4 weeks, which just highlights how few losses we actually have had at a time where everything seems to melt up.
The next stop for this market is Chairman Powell, addressing the market and the economy a little bit later on this afternoon. Take a look at what's happening with precious metals going into this. Gold just pulling back from all-time highs. Silver, a 5-day streak, a run of something like 7%. And a big question, I think, in the commodity market and elsewhere, Annmarie, the question is the commitment to get inflation back to 2%.
Well, exactly. Cameron Christ this morning writing that the Fed has never in its history cut rates when the economy is this good, never mind inflation. And then you look at commodities and you see that inflation uptick across the board. Bank of America this morning, Jonathan, upping their calls on Brent and WTI. And then when everyone's saying the Fed may cut in June, that's going to be peak driving season. Bank of America has $95 a barrel this summer.
Well, let's get to crude. Shock. I think we're all shocked. The US cancelling the latest oil reserve refill plan. Here's the quote: keeping the taxpayers' interest at the forefront. I don't think any of us are surprised by the latest move.
No, the question is what more are they going to do, right? Basically, the idea here is they're not going to go into the free market and add to some of the demand they've had in the crude market to try to juice up prices. So are we going to end up with basically further releases of already depleted stocks of the Strategic Petroleum Reserve heading into an election season, given some of these pressures? A bigger question might be, will that matter for gasoline prices? Because refineries and barrels are two different things.
Right, and it takes time for that to trickle down, at least a few months. Potentially, though, they could put pressure on OPEC+. The group is meeting today. We're not expecting anything out of it today. But what happens in the next few months if we do this uptick in prices? The conversations I've been having, everyone debating the oil market, is whether this is temporary or this is truly dislocations in supply and demand.
Can we check out a single name as well, just before we run away? TSMC. Let's talk about what's happening in Taiwan. The biggest earthquake to hit Taiwan in something like 25 years, Bramo. That stock is down 1.5%.
And part of the reason why is because we just don't know how long some of the operations are going to be taken offline. And Marie, you've been mentioning this quite a bit, that this is a concern because so many chips are produced in Taiwan. What kind of supply chain disruptions could there be? I want to just read this one quote by a couple of analysts. Some of the high-end chips need 24/7 seamless operations in a vacuum state for a few weeks. Operation halts in Taiwan's northern industrial areas could mean some high-end chips in production may be spoiled. That, to me, is fascinating from two perspectives. One, how disruptive just even a temporary supply shock could be, but also how difficult it is to make these chips.
And TSMC is already moving staff around. And the issue is, to your point, we've been talking about this a lot, U.S. tech companies are so exposed to Taiwan. Now, this is just an earthquake, but everyone talks about the geopolitical risk, and we're still waiting on what the impact is, to your point, Lisa, of these high-precision semiconductors. One single vibration can destroy an entire batch.
Still assessing the fallout from that particular quake. We'll be catching up with Mandeep Singh of Bloomberg Intelligence later on in the programme. To get things started this morning, equity futures pulling back by just 0.2% on the S&P 500. Looking to find some stability in the bond market with the yield tied by a basis point or two. 436.52. New highs for the year, Lisa, on a 10-year maturity, on a 30-year as well.
And people are wondering how high they could go. We heard yesterday this idea from Troy Gayeski of a 5% 10-year yield. I guess we'll see. Whether we're going to test the 450, I guess we'll see. Let's get those auctions started again. Are we going to care then? I mean, really, are we at the point where people are starting to perk up to this idea of longer-term inflation and say, OK, let's go? And how does Jay Powell respond to it?
Peter Chair of Economy saying that supply story, those supply dynamics will reassert themselves. Can we talk about inflation in Europe just briefly as well?
Yeah.
I had one question when that number dropped. Weren't they cutting interest rates already? The inflation dynamics are very different in Europe compared to the United States, but the growth backdrop in Europe compared to America is just absolutely dreadful and has been for a long time.
You nailed this earlier when you said that they're conditioned by the mistakes of the past. They're conditioned by the fact that they did not get inflation right. They didn't act as aggressively as they should have. It's a good question. A lot of people have been talking about this. This was the predominant thought, was that Europe would cut first. Are they actually in a cutting cycle that the U.S. cannot be in? And what does that mean for the euro? We talked about parity calls. We talked about all the weakness. Let's see if that starts to really come to the fore.
And can they go without the Fed joining them? That's another question as well. Euro right now against the dollar, 107.69. Coming up this hour, Margie Bittal of Allspring on fading bets for a June rate cut. Pierre Ferragu of New Street as Tesla disappoints. And Gilles Moak of AXA ahead of new comments from Chairman Powell. We begin with our top story. Higher bond yields weighing on markets as investors lower expectations for rate cuts this year. Margie Bittal of Allspring saying this. Continued growth will suggest to the Fed that interest rate cuts are not needed in order to ensure the economy continues to advance. Many signals suggest that while inflation may continue to decline, it may stabilise at levels well above their target of 2%. Margie Bittal joins us now for more. Margie, when you look across the commodity market, you look into fixed income, do you think we're beginning to question the commitment of the Federal Reserve to get inflation back down to 2%?
Well, I think the ability to get to 2%, frankly, is out of the Fed's control. But it seems that as we see the economy continue to be very strong, it doesn't need rate cuts to continue at these levels. And also, it looks, there are signs here or there that although inflation's come down, other parts of the inflation picture look as if it's stabilizing at levels significantly above 2%. So the Fed really doesn't have much of a case right now to cut rates.
Is that a reason for bond yields to remain elevated? And if that's the case, Margie, we've got to figure out this evolving relationship between bonds and equities. It's a different story at the back end of last year compared to the start of this year. Just what is the relationship as yields start to disrupt equities a bit in the last couple of days?
Well, it's really hard to see how a yield on the 10-year of a 4.3 to a 4.5, even higher, can have much effect on the real economy when you have inflation clocking along at, say, 2.5%, 3%, something like that. It hasn't affected economic growth so far when we've had periods when it's dipped up a little bit. So I think I hate to say it's irrelevant, but honestly, it looks irrelevant. We had the Fed raise 500 basis points in short rates, and the economy has moved along with only one quarter where we had a negative quarter.
Are you rejecting the idea, Margie, of long and variable lags, essentially?
Well, you know, they're so long and so variable, they're really meaningless for an investor to make a position out of it.
Which raises this question of whether people have perhaps tied the idea of bond yields to stock returns a little bit too closely. Do you take signal, or do you say it's noise that yesterday stocks fell in tandem with bonds?
Oh, I think that particularly the tech sector got off to such a huge start. It just needs to take a little rest here and maybe have a little bit of a correction. And there's always trading money that's looking towards, will the Fed cut 1, 2, or 3 times, even though that's diminished. So I think it really is more noise. Economic growth was strong. It looks, the signals are in the first quarter, it's also going to be strong with profit margin maintaining. So that says we're going to have another good market this year.
Margie, you've nailed it over the past couple of years. Traditionally, you really made your name in the bond market, and recently you've been going into stocks pretty much, not exclusively, but definitely more so than into bonds. Are you continuing on that path? Do you feel like that is the trade of, frankly, the next 5 to 10 years, just simply because rates cannot come down so much from where they are now?
I don't know if I could go 5 to 10 years, but certainly for the next year or so, I think we'll get better returns from equity on balance. I mean, even high-yield bonds, which is the best part of the bond market, in my opinion, the yields are, say, 6.5 to, say, 7 3/4, which is really a pretty low hurdle rate for equities to do better. I think the defaults will be very low in high yield, so you have to keep that extra yield. But really, when you look at total return, it just says with the uncertainty, you're better off in equities this year.
Margie, what do you think we're going to hear from Jay Powell today? Do you think he's going to be shifting potentially towards the Raphael Bostics of the Fed or those of, say, Mary Daly and Loretta Mester?
Well, I think he's really, he has, as I said, a real problem because they sort of telegraphed they were looking to cut rates. And when you look at the economic conditions, it really doesn't seem to be justified. So it's almost as if he's, like the rest of us, looking at the market for signals on what he ought to be doing rather than having a game plan that's where he has a better plan, say, than investors do. So
Margie, up until recently, the market was saying everything's awesome. You just said something quite remarkable. You like high yield as the best part of fixed income. Why is that, Margie?
Well, because I think the risk is low because the economy is growing, and actually high-yield bonds are telegraphing that because yield spreads have actually compressed a bit, saying that they're not too worried about defaults. And really, everything look at the economy says, commodities look as if the economy's strong, and that's really the best backdrop for high yield, not so much the Fed making a quarter, half a point change in short rates, but what are the economic fundamentals that these companies use to cover their debt service.
Margie, this is really important. You see tight spreads as a reflection of strength and not of complacency. Why is that?
Just because the facts say the economy is in good shape. I think what really has people off is we had the Fed raise short rates 500 basis points, and we didn't have a recession. So it just seems as if the market isn't right. We should have had a recession. The Fed comes to our rescue, cuts rates, and the economy goes off. We really didn't have that. We've had a few little pauses here, but I think it shows you that the economy doesn't have any imbalances, and we should, I think, grow surprisingly well this year. So another year of economic surprises, a surprisingly good equity market.
We've been talking about the balance of risks, and I expect that we'll hear some of that from Fed Chair Powell today in a speech at Stanford in tandem with the CEO of Google and Alphabet. I am curious whether you think that the biggest policy error right now is not tackling inflation enough, and the idea of inflation becoming more entrenched and being higher for longer in a way that people are not prepared for.
Well, I do think inflation is going to be higher, maybe only a smaller amount, and for longer because of all the buildup that we had with very low interest rates, with deficit financing. I think that really bakes into the cake an inflation level above that 2% for the foreseeable future. But that doesn't mean we have a bad economy, and it doesn't mean that corporate profits will go down. In fact, that's a signal to me they can maintain profit margins if you have some inflation helping.
Interesting. Margie, wonderful to hear from you. Margie Patel there of Allspring. Her view on this market, equities and bonds, and in fixed income, high yield, spreads at multi-year tights, there and thereabouts. Seeing that as a reflection of strength and maybe not a reflection of complacency, which is what we've heard around this table a few times. Look, if we can stand up, if the broader economy can stand up to interest rates of north of 5%, that's one thing. Can pockets of the economy continue to get by? And I'm thinking of commercial real estate. Moody's out yesterday. This is the quote from Moody's. I know you saw the same thing. The office stress isn't quite done yet. Vacancies rising to a record 19.8%. If you're going to see higher for longer, can those parts of the economy really stand up to that story for much longer?
And does it matter? Right. I mean, I guess that's the other question, because we've been talking about the pockets of the economy that have been really hit much harder than others and been left behind. And I'm talking about commercial real estate. I'm also talking about segments of the income population that don't have the reserves to really tackle some of these issues, or people who don't own homes. To me, it remains to be seen. How much is the Fed going to cater to some of these pockets of concern and cut rates without necessarily putting inflation first? That is what we keep hearing from people. I would love to hear that from Fed Chair Powell. Please respond.
Are you willing to trade financial stability for price stability? Is that the question?
That could be one of them. Are you willing to trade potentially blowing out pockets of the population and reducing their chances for employment, reducing their chances for wealth and prosperity in order to target a certain inflation target? I don't know the answer to that, but this is a very socially conscious Fed, as you mentioned yesterday. And that definitely is weighing on them at a time where it does seem like Margie is correct, that things are all being, pretty positive, and we seem to be chugging along with rates where they are.
Chairman Powell, a little bit later on this afternoon. Equity futures right now negative by 0.25% on the S&P. Let's get you an update on stories elsewhere. Here's your Bloomberg brief with Yahira Hackers. Hey, Yahira.
Hi, John. Inflation in Europe inching towards 2%. Firming up prospects of a June rate cut at the ECB. Consumer prices rising 2.4% in March, a lower rate than analysts forecast, and down from a 2.6% read in February. Core CPI also eased at a faster rate than expected. ECB President Christine Lagarde has signaled a first rate cut in June, with much of the central bank's governing council on board with that timeline. Taiwan has been hit by the strongest earthquake in 25 years. At least 7 people have been killed and more than 700 injured during the 7.4 magnitude quake on the east of the island. Rescue workers are scrambling to find more than 70 people who remain trapped after the earthquake leveled dozens of buildings. President Biden and former President Trump both added to their delegate counts last night. 4 more states held primaries on Tuesday, and the presumptive nominees easily won in New York, Connecticut, Rhode Island, and Wisconsin. Trump picked up 78 to 84% of the Republican vote, while Biden took 83 to 91.5% on the Democratic side. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on this program, Biden holding talks with Xi.
The teams have been working a lot since November, and both presidents thought that now, a few months later, this was a good time to kind of check in with one another, see how that's going, discuss the future.
Discussing the future in China, Treasury Secretary Janet Yellen heading to China. This in Chinese state media, the biggest threat to economic globalization, the United States. Did you see this?
Again, all of this is so rich. Yes, I did. It's just, really.
And the current weighs in up next. Counting it down to payrolls Friday, 214 is the median estimate in our survey. As we often say, that is a moving target. We get more estimates, that's going to shift, but at the moment it's climbing, inching higher from about 200k in the last week, just inching higher to about 214 right now, the previous number 275. Equity futures on the S&P 500 this Wednesday morning, negative. We're down by 0.2%. Yields creeping a little bit higher by a single basis point, 436.32. Under surveillance this morning, Biden holding talks with Xi.
The teams have been working a lot since November on fentanyl precursors, on climate change, on economic practices. So there's been, on artificial intelligence, there's been a lot of staff level work, and both presidents thought that now, a few months later, this was a good time to kind of check in with one another, see how that's going, discuss the future.
Here's the latest this morning. President Biden, China's Xi Jinping, speaking by phone in their first one-on-one conversation since November. The White House calling the conversation, quote, candid and constructive. The president's discussing everything from TikTok to military cooperation. The phone call coming ahead of Treasury Secretary Janet Yellen's trip to China later this week, her second trip in just 9 months. Bloomberg's Enda Curran joins us now for more. And based on how that call went, what's on the agenda for the Treasury Secretary?
It seems industrial overcapacity is a theme that's emerging this week, John. That came out in the call between Biden and Xi that you were just mentioning there. Some analysts taking from the call, by the way, that there might even be some US action coming on this side of the election. Treasury Secretary Yellen will go to Guangzhou, that's the heart of China's manufacturing and industrial base, and then go up to Beijing. And it's expected that she will be raising concerns. Last week she went to a solar panel factory that was forced to shut down in Georgia as an example of the complaints that the US have where Chinese industrial capacity or exporting cheap goods is hurting the global economy. So that seems to be one theme that is emerging from the Yellen visit and from the Biden-Xi talks. But also, let's not forget, it's also about putting guardrails and stabilising the relations between the world's two biggest economies.
Ahead of that trip, she tells the Wall Street Journal, people like me grew up with the view, if people send you cheap goods, you should send a thank you note. That's what standard economics basically says. I would never, ever again say, send a thank you note. This is a shift from Yellen from the start of the Biden administration. She wasn't a total hawk. What has changed in terms of how Janet Yellen views China?
Absolutely right. The Treasury Secretary has travelled a journey on China, Annmarie, and this speaks to the point of where US politics is right now, the bipartisan, hawkish approach to trade with China, and this is why, for example, there's an expectation now that there might be more steps coming in terms of what they can do to tackle oversupply or excess capacity from the Chinese side. But let's not forget that China is pushing back against this as well. For example, in that readout between Biden and Xi, the Chinese readout made it clear that they will not sit by and do nothing while the US continues to put controls on Chinese technology companies, for example. So there's a clear pushback there. And they also made it clear that putting sanctions on Chinese companies isn't de-risking, it's creating new risks. So this is not a one-sided thing, even though Ms. Yellen is expected to raise these concerns, and as you say, she's certainly entered a hawkish camp. China's pushing back too, making clear that it's not going to take this economic fight lying down.
China state media really focused on one line she said, according in this meeting. He told Biden, don't flip-flop, don't stir up trouble, don't cross the line. When you look at the two readouts from both countries, did they agree on anything, Enda?
I think there's commonality there on sort of the low-hanging fruit, so to speak. Modest cooperation on AI, some cooperation on climate change. Clearly, they're working for some cooperation on the narcotics control, Annmarie. So there are areas where they're coming together. And there, of course, I think there's a broad theme as well, by the way, that we're 6 or 7 months out from the US election now. It's kind of time out. China won't really want to go too deep on a strategy with the US this side of so close to an election. But all that said, none of the underlying problems have been solved. I mean, even as we have this talk of cooperation, we just spoke about the Treasury Secretary going to Beijing this week with a laundry list of complaints to bring to the Chinese government. And, of course, within that readout between Biden and Xi as well, Biden raising concerns over China's support for Russia, China's activities on the South China Sea, and so on. So it's about guardrails, about stabilising things, but it feels more like time out. None of this has really been resolved.
And bear with me here. But as I read about all these calls, I'm wondering, how does this go down? Does someone say, I really need to talk to you. I'm having a really hard time with my economy. Let's get this going. How does it sort of transpire? Who has more leverage at this point economically as you have these discussions and these, tit for tats and raising concerns? I mean, they've been raising concerns for a long time. Do we have a sense of what the catalyst here is?
I think last year when they had that meeting in November, Lisa, there was a feeling that the US had the upper hand. The US economy was going gangbusters. China's economy, much less so. But importantly, sentiment towards China's economy from foreign investors, especially US investors, in the doldrums. Now there's a feeling China's trying to tilt the focus back towards its economy, stabilise things. And remember last week, President Xi Jinping holding that last-minute meeting with US CEOs. They are clearly trying to get US business and investors engaged again. So there is a feeling that at least on the economic side of things, the US has the upper hand, given the strength of the economy here. China, of course, is looking for investment from the rest of the world, so they are trying to get that back on an even keel. But that's really where I think that's maybe the only part where the US does have leverage. Elsewhere, we had a poll out this week, polling nations in Southeast Asia, indicating that popular opinion there has swung towards China for the first time away from the US, and that speaks to the challenges that the US has on the global stage, be it Gaza or be it, of course, Ukraine. So some leverage on the economic side, but elsewhere the US has plenty of challenges in terms of wooing the global south when it comes to China.
Massive challenges. Can we just finish on policy and the prospect of getting tariffs sometime soon? And we've been waiting for a decision on Chinese EVs. I think BYD and Focus for many. When is that decision going to come?
No real hint of the timing on that, John. There was a nod to the tariff discussion in that Xi-Biden readout yesterday. We don't have much more than that, other than, broadly speaking, people expect this hawkish trade policy to continue. Obviously, industrial oversupply is a concern. EVs are part of that. It'll be very interesting to see what comes out of Yellen's trip to Beijing later this week.
And thank you, sir. Great to catch up with you, sir. Appreciate the update. Enda Curran there of Bloomberg down in Washington, D.C. Let's check out shares of Tesla. Yesterday, down by close to 5%. This morning, negative by something like 0.9. The team here at Bloomberg crunching the numbers. The share of the Chinese market over at Tesla going from 10.5% in the first quarter of 23 to around 6.7% in the first quarter of this year.
How much is just a pricing issue? We talked about this before, that a lot of the Chinese models are having a lot lower prices. Also, they're being supported and they're being pushed out there, and there's sort of this nationalist streak. Can Tesla continue to do well without the Chinese market, which is the biggest one for electric vehicles?
That market is hyper competitive. Pierre Ferragu of New Street Research on Tesla coming up very shortly, with the stock down by about 0.9% in the pre-market after falling yesterday by close to 5 percentage points. The broader market looks a little something like this. In the equity market, equity futures on the S&P 500 negative by 0.2%. Yields creeping a little bit higher once again by a basis point or two, 436.52. And in the commodity market, the rally continues. New highs for 2024 in the last 24 hours. 85 on WTI, 89 on Brent. Two days of losses to kick off at Q2. Your equity market on the S&P 500 attempting to prevent that from becoming day three. Equity futures at the moment not doing that. We're negative by 0.2% on the S&P. On the Nasdaq, we're down by 0.35. The Russell, the big rotation you were looking for. Small caps did not work yesterday. Down 1.8% and down close to 3%, Lisa, in just 2 trading days. Small caps didn't work. Energy did. So parts of this rotation still held up.
Well, and that was very tied to the fact that energy prices were flying, and yet we got bond yields flying as well, which is part of the reason why we were saying yesterday, how much do higher yields challenge the rotation trade? Yesterday seemed to indicate maybe quite a bit. Then we heard from Margaret Patel, it's all noise. So we shall see. But yesterday, definitely bonds very much in focus for a lot of these other sectors.
Well, let's get to the bond market. The 2-year, the 10-year, the 30-year. We're talking about levels that we haven't seen so far this year, going through the year-to-date highs. 436.52 on a US 10-year, up a single basis point. On a 30-year, we are back through 450. This idea that maybe we won't get any cuts this summer based on how strong the economic data has been. Now, strong economic data without inflationary pressure is one thing, which I think is the Fed's hope and dream. This market might be spooked by the prices paid component of the ISM, which is something you brought up a couple of times yesterday.
Although I wonder what triggered it this time, because people have been very good at dismissing every single data point. I love how people try to ramp up excitement for the upcoming information that we're going to get. For example, Pantheon came out we get ISM services today and ADP. This was the headline. ISM services and ADP employment reports are both deeply unreliable. So you still have people coming out and basically saying ignore all of these data points. So what triggered it this time? Because we've been getting this steady drip, and yet a lot of the Fed officials don't seem to be concerned and seem to say this is pretty much in line with our expectations.
Even 24 hours ago, we were looking at these moves in this bond market, in commodities, and we can check out crude right now. And equities were down by a couple of tenths of 1%. It was like a snoozy equity market in the face of what was developing elsewhere. You've seen the move in crude. Brent now approaching 90 again at 89.32. It's the move in precious metals that gets my attention over the last couple of weeks, though. All-time highs on gold repeatedly over the last month. Silver breaking out yesterday. And just fueling those questions, those big questions we've all got, the commitment to getting inflation back down to 2%.
Are gold and silver better proxies for inflation havens than any other asset class, right? That's sort of the question that a lot of people are looking to. Or, and either way you cut it, or some of these precious metals flying because industrial production is so great, and so people are having demand for them. Either way you cut it, it points to strength and it points to ongoing pricing pressure. And that maybe is causing people to really wake up to that idea a little bit more.
Let's get to the Fed speak. Under surveillance this morning, Fed Presidents Daly and Mester holding the line, urging patience before cutting rates this year. Mary Daly saying yesterday that 3 cuts is a reasonable baseline. Loretta Mester saying she wasn't surprised by hotter than expected readings to start the year, adding, quote, I need to see more data to raise my confidence. We'll hear from Chairman Powell once again just after noon Eastern time, a little bit later on this afternoon. Annmarie, at the start of the year, 3 cuts from the Federal Reserve was hawkish because this market was at 6. 3 months later, 3 cuts of the Federal Reserve is dovish because this market has moved so much in the first quarter.
Right, and PIMCO coming out, and they've said they've already seen enough already and positioning for the Fed to deliver fewer cuts than any other major central bank. We only just heard from Chair Powell on Friday, but within that time, we've seen rate expectations change yet again. So that's what everyone's going to want to be parsing through when he speaks today. And of course, it comes ahead of jobs numbers on Friday.
It's kind of laughable, Lisa, how much the market has moved and how little Federal Reserve officials have moved.
Well, basically, the market's not really listening to the Fed anymore. The market's looking at the data. And the problem is the data is incredibly confusing, as we hear from a lot of people, and you can kind of paint your own narrative. What I'm looking for is Chair Powell is speaking at 12:10 p.m. Eastern at Stanford on the West Coast. Right after him, Sundar Pichai, the CEO of Google and Alphabet, is speaking. And I think that this pairing is fascinating because these are the kind of the 2 prongs of the market so far this year. You have monetary policy, and then you have the AI hopes and dreams that are going to revolutionize productivity. How much do they talk to each other at a time where really people can't get these stories straight? This, to me, has been sort of the framing narrative for a year. It's been highly confusing.
The supply side hope and dream of the chairman of the Federal Reserve. You might hear more on that a little bit later. Let's get to our next story, a serious one. President Biden ramping up criticism of Israel's campaign in Gaza after military strikes killed 7 aid workers. Biden saying in a statement, quote, Israel has not done enough to protect aid workers trying to deliver desperately needed help to civilians. Comments also coming from World Central Kitchen founder Jose Andres, UK Prime Minister Rishi Sunak and Australian PM Anthony Albanese. The pressure ramping up in a much bigger way.
Absolutely. And what struck me about this Biden statement is that it was in black and white. Israel has not done enough. It wasn't leaked to the press. This is tough. This was clear language from the President of the United States. We should note 1 American was killed in that hit as well in Gaza. But at the same time, reports that the Biden administration is pressing Congress for $18 billion of the sale of F-15 jets to go to Israel. And this is what takes individuals within the Democratic Party take issue with.
That's the latest on that front. We'll continue that story. Need to give you an update on the deadly earthquake in Taiwan, striking overnight, killing at least 7 people. The 7.4 magnitude quake, the strongest in 25 years. Companies for the advanced chip-making hub assessing the damage this morning. Taiwan Semiconductor saying it has moved staff out of production centres. The company is a major supplier to companies like Apple, Nvidia and others. Taiwan is the source of approximately 80 to 90%, Lisa, of the world's highest-end chips.
There are two stories here, obviously, the human story and just sort of this question of we hope that everyone is okay. And then there's the industrial side of the story, which is that Taiwan is such a massive center of production of this key asset that we use in everyday goods. What this highlighted is just how difficult it is to make these. The idea that vibrations could really throw production off, or not some sort of seamless vacuumed-in kind of process could cause these to be destroyed. It just shows that it's going to be tough to move the production to Japan or to the U.S. or some of these other areas.
If you read Chip Wars, I'm not sure if you've read that book, but literally the first few pages about how vulnerable the supply chain is because of where these factories actually are. Taiwan vulnerable to earthquakes and other epicenters for chip making as well. If you could pick out the worst places to put some of these companies, that's exactly where they are.
Yes, and the issue is, to Lisa's point, there is no substitute as of yet for these high-end chips. Now, we're still assessing how much is potentially going to be taken off market with these earthquakes. But to your point exactly, Jonathan, there's two issues. One is the physicality because of the fractures in the earth, but then also add in the geopolitical risk, which is why I think this is interesting. If you want to see the exposure U.S. companies have, this isn't a geopolitical risk issue with Taiwan. This has to do from an earthquake. But what if there was a geopolitical risk? That's the key question.
Still assessing the damage this morning. More updates throughout the programme this morning on Bloomberg TV and on Bloomberg Radio. Take a look at shares of Tesla continuing to slide this morning. The company reporting its biggest sales miss ever, delivering just under 387,000 vehicles in the first quarter. The number far below the most bearish estimates on Wall Street. Pierre Ferro of New Street Research writing this: "We are less confident about timing, but remain confident Tesla will continue to grind share in the high end and expand in the broader market with the Model 2. Pierre covers Tesla for New Street with a buy rating and a price target of 280. I'm pleased to say that Pierre Ferro joined us right now. Pierre, I want to start with a quote from a peer of yours over at Deutsche Bank, Emmanuel Rosner, who said this: "Beyond the known production bottleneck, there may also be a serious demand issue." How much of that number do you think was about the bottlenecks, the production issues that they've had in the last few months? How much of it was just a fall-off, a big fall-off in demand?
Thanks, John. So we were like really on top of the production issues, you know, the fire in Berlin and a few other issues related also to the situation in the Middle East affecting the supply chain. And we were expecting like 410 to 420,000 units. And Tesla actually delivered only 380, 390. So there is a very, very significant shortfall that cannot be attributed at all to production issues. Now it's like it's a few tens of thousands of cars. What we've seen is that in the US, demand has been extremely, extremely low. Inventories have been building up much more than we were anticipating, and that despite, you know, significant discount activity on the inventory. So demand is really, really, really bad. And then I don't want to sugarcoat, you know, the quarter. Reality is that if you have supply issues getting you down here, but demand is still fine, then even if demand is slightly weaker, it shouldn't be affecting your deliveries at the end of the quarter. The fact that demand went below where delivery could be means that demand is extremely, extremely poor. So a very, very tough quarter, a very, very tough wake-up call for Tesla. Now, remember, it's winter. It's January, February, March. These are months that have been historically extremely difficult and very volatile, very unpredictable for the high end of the car market. For some reason, we've seen that in the past, in 2019, in 2018. Sometimes some brands really have like barely any sales in January and February, and nobody is out in the market in Europe and in the US buying these cars. And Tesla doesn't have their own dealers. So when they get hit by like an air pocket in the market like that, it's instantly visible in their numbers. So The thing I would say is I wouldn't overinterpret, what's happening. Let's take a step back. Tesla gained 15 points of market share out of nothing in a few years in the very high end of the car market, in the premium car market, with a new brand, a new positioning, very unique, very differentiated cars. And from this 15% market share, now what we see is that Tesla is not going to gain to increase by 30 or 40% their volumes year over year anymore. The best we can hope in that segment is that Tesla keeps creeping up market share, go from 15 to 16 to 17 to 19% market share, and hopefully eventually towards 20%. But this is not going to deliver a lot of growth. The real growth opportunity for Tesla in the car industry now is actually expanding the product portfolio towards like an entry price model, because that quadruples the size of the market in volumes for Tesla, of course, and that's the Model 2, what we call the Model 2, the next generation platform.
Just quickly here, Pierre, I am curious about whether your bullish call for Tesla is hinged on the idea that Tesla is not ultimately a car company, but it's more tied to some of the batteries and other products that are fueling some optimism that its valuation can still be justified.
Yes, Lisa, it's a very good question. So you look at a factory of Tesla and you analyze it, and you analyze, its economics, its operating model. It's a chip factory. It's like the economics of a Tesla factory are similar to the economics actually of a TSMC factory. It's very high return on operating assets. It's very, very efficient marketing, a lot of very, very high speed innovation. So from that perspective, Tesla is definitely not a car manufacturer, and that's the reason why we think Tesla can actually grow much faster than the traditional car market, because they basically replace, it's like the smartphone, 10 years ago replacing the mobile phone, but the Tesla type car that is like driving fairly autonomously, that is running on a battery, and that offers a very different driving experience, are progressively replacing traditional cars based on IC and with less technology. So from that perspective, it's not a car company. Now, unfortunately, the way we human behave in the car market is affecting Tesla. And buying a car is a very big one-off decision. It has always been very volatile on short cycles. The car industry adapted to that over decades and decades with a distribution operation, a distribution model that absorbs the short-term variations in demand. Tesla doesn't have that. Tesla goes straight into the market from a website and gets hits. And so it's a tough wake-up call, and it's a tough learning event this quarter. But it reminds us that, yes, Tesla can potentially be very, very volatile in terms of delivery. And that's what's happening today.
Pierre, we also love to get your reaction from the earthquake that hit Taiwan. We understand TSMC is moving staff out of certain areas. They're still assessing the impact of the production. What do you make of this?
Yes, so no significant damage. We were on the phone with Taiwan earlier today, and it looks like there is no significant damage, like asset losses related to the earthquake. There is the situation, of course, is still risky with the risk of aftershocks. But so far, you haven't had damages to the assets, which is very good news. So there isn't like a structural change in the production capacity of Taiwan or anything like that. Now, there are factories that have been evacuated for safety. And most importantly, as you were referring to, there are some steps in the process of manufacturing chips where you're positioning things by the nanometer. And so if the Earth is shaking, even if it's like 50 kilometers away from you, this is messing up that step of the process. And the wafer that was in the tool being printed or being annealed, for instance, can be thrown away. The wafer is destroyed and it's not going to work. So there are going to be some short-term production impact. So you will probably see in weeks to come some companies explaining that they don't have enough supply, but it's going to be a matter, in leading-edge manufacturing, you count like cycle times in weeks, in a few weeks. If you add to that a bit of disruption in the supply chain, It could extend maybe to 1 or 2 months, but it's going to be relatively short-lived production disruption, but the fabs are still there. Now, what's very interesting here is that it's another big wake-up call for us, which is like we all rely on farms that are sitting in Taiwan, and the situation could have been much, much worse, and we could have lost production capacity. And if we are losing production capacity, we would be back into an after-COVID kind of situation where the whole economy is, struggling to find chips. And I would relate that to what Intel did yesterday. Intel presented their new, the implementation of their IDM 2.0 strategy, creating like a fully fledged foundry. And then TSMC also earlier this week announced that their fab, they had line of sight on the first wafers coming out of their fab in the US. So what I find very interesting is that, yes, today Taiwan was hit by an earthquake. It's a tragedy, and I feel terrible for them. But it's happening at a point in time where actually the regionalization of leading edge manufacturing is actually just taking off. And it was almost a decade in the making. It's very, very slow to get the first Taiwan semiconductor fab in the US, but we almost have it. It's almost done. It took like half a decade for Intel to turn around, reorganize itself, and become a foundry, but it's almost done. So, which means that it's still going to take 5 to 10 years for these businesses to really scale and really become significant share of production, and similar things happen in Japan. But I think we are, with this earthquake, entering, and of course the earthquake is going to help people remain very motivated to make that happen. But we are now going to see leading edge manufacturing getting more regionalized, and that's good for us. That's good for everybody.
Hey, Pierre, appreciate the insight. Valuable stuff this morning, as always. Pierre Farragut there of New Street Research. Taiwan Semi, a little bit softer in today's session. Up next on the programme, 3 rate cuts still on the table.
3 rate cuts is a projection, and a projection is not a promise. But we have more work to do before I'm confident that on that path.
That conversation up next. Two-day losing streak so far this quarter. Equity futures negative by another 0.2%, threatening to make that day 3. Yields are higher by a single basis point, 436.52. Under surveillance this morning, 3 rate cuts still on the table.
3 rate cuts is a projection, and a projection is not a promise. If I look at my projection and I say, well, what if inflation's stickier? We may want to cut less. What if the labor market starts to falter or inflation comes down more rapidly? Well, then we might be in a position where we would think cutting more is appropriate. With a projection of 3 interest rate cuts, that still seems reasonable, but we have more work to do before I'm confident that on that path.
Here's the latest this morning. Fed Presidents Daly and Mester urging patience ahead of comments from Chairman Powell later on today, and US payrolls on Friday. Jim Moak of AXA saying this: market expectations at 170 makes sense. The pay print will be crucial as long as it's not too far from 4% in the 3-month annualized terms. It's okay, given the strength of productivity, to keep us towards 2% inflation and to keep Powell on the dovish side. Jill, I'm pleased to say, joins us now. Jill, that's the Fed. That's the market backdrop in the United States. I actually want to start with Europe. The inflation data we got earlier this morning, and the question that I had earlier on, as soon as it dropped, why aren't they cutting interest rates already in Frankfurt, Germany?
But they will. They will. I think they will cut in June. There might be some members calling for an early move, but I don't think it really matters. The direction of travel is now increasingly clear to everyone on this side of the pond. And the hawks may still be able to say, look, even if we've had another good print for inflation today, well, you have this resilience in services prices, which keep us a bit on our toes. So there's probably enough there for the hawks to continue to want a bit of delay in the reaction, even if, again, and it's clear to everyone where they're going to go. And it's already quite a significant shift, I would say, in tone from the ECB in just 2 to 3 months. So, okay, maybe June is a bit too late. in the great scheme of things, I don't think that moving it forward by just one meeting would make a hell of a difference.
Gilles, it does make a question, though, here of how much of a cycle this is going to be. People questioning whether the Fed could potentially cut rates once and then be done for the rest of this year. For the ECB, do they care if they're cutting much more aggressively than the Federal Reserve? Is that kind of weighing on them in this calculus?
Actually, Christine Lagarde was explicitly asked about this, and her answer was unambiguous. They will do whatever is needed considering the conditions in the Eurozone. The only thing which would make them think twice about decoupling from the Fed would be if we had an issue with the exchange rate. But I would certainly argue that at this point in time, even if cutting faster than the Fed could trigger a further depreciation of the euro, it would be okay from an inflation point of view, because the root source of the resilience in prices we have in Europe right now is not on the outside. It's domestic. It's versus inflation. The price of manufactured goods, which are massively imported, continues to go in the right direction. So we could probably take a bit of currency depreciation without adding too much in terms of inflationary pressure. So that is the usual conduit. And I would say in the current configuration, there's not enough concern on the FX side to stay in the hand of the ECB. If they think they need to cut, they will. And I don't think they will wait for the Fed. In any case, in June, they have to make the decisions ahead of the Fed. So it will be a leap of faith anyway for them.
Gilles, you make a broader point here about currency and the potential for weakness to be viewed as a good thing by certain governments, especially as we do see this incredible ramping up of competition on the industrial side of things. Do you think that, in a sense, there could be a race to the bottom with respect to weakening different nations' currencies to try to be more competitive on the international stage at a time where the U.S. and China both are trying to ramp up industrial production?
Yeah, that's a risk, especially if we have another dose of protectionist measures going from the U.S. after November. I mean, I think we need to take this seriously. If we end up with more U.S. tariffs on imported products, one temptation, a very natural temptation for other countries would be to allow the currency to depreciate. And during the first trade war under the first mandate of Donald Trump, China did not actually depreciate its currency that much. There was a bit of depreciation, but it was not significant. This time around, especially if we talk about tariffs being hiked to 60% from 25%, it will be a big temptation for China to use the currency, especially in a situation in which actually domestic demand would probably benefit from a looser monetary policy. That's a very different situation from where we were back in 2018. So there's no conflict of objectives in a way for China between the domestic and the external objectives when it comes to lose a monetary policy and allow the currency to depreciate. The question then would be for Europe. We are already increasingly nervous at competition of Chinese products on a number of strategic sectors, for instance, the car industry. If on top of everything else we have further depreciation from China to deal with protectionist measures in the US, then there could be, as an after effect, a temptation in Europe as well to allow its currency to depreciate. We do not have as much control on our currency as China. We do not manage the exchange rate. But it would be another reason for the ECB to run a monetary policy that would be significantly looser than the Fed's to allow actually some depreciation of the currency to help us on the external side.
Fascinating. Gilles, thank you, sir. Gilles Moak there of AXA Investment Managers. Deeply thoughtful stuff on foreign exchange at the end.
Especially paired with geopolitical policy and this idea of the industrial production, the competition that's ramping up.
Does that mean Chinese officials start buying treasuries again?
That means that they can cut rates to zero.
Hand over fist,
Yeah, something like that.
Coming up next, Eric Val of T. Rowe Price, Ed Morse of Hartree Partners, former White House fellow Elliot Ackerman, and Michael Collins of PGIM Fixed Income. That and a whole lot more. The second hour of Bloomberg Surveillance up next.
there are pockets of the economy where you've certainly seen the impact of higher rates.
We're generally playing duration from the long side, much more comfortable in the short to intermediate end of the curve.
The overall trend in inflation is still going in the right direction, and that's the strongest argument for extending duration in the bond market.
These inverted yield curves that we've been watching for the last 2 years, those may become positively sloped again.
There's a material risk of substantially higher rates at the back end of the curve, and we could retest the 5% level at some point.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Q2 is beginning very quickly. From New York City this morning, good morning for our audience worldwide. The second hour of Bloomberg Surveillance begins right now. With a bit of weakness in the equity market over the last 2 days, make it day 3. Equity futures on the S&P negative by 0.2%, and some key levels being broken in the bond market too. So let's discuss it. New highs for the year on a 10-year maturity, on a 30 maturity. We are through 450. On a 30-year yield, we are through 430. A clean break of that in the last couple of days on a 10-year.
You set that up perfectly. This question of whether a sell-off in bonds is actually good news for equities, which was the theme of the first quarter, it really speaks to strength. Second quarter starting off with, wait a second, maybe not so fast. Maybe this is a little bit concerning.
We've been talking about Fed officials throughout this morning. We heard from Mary Daly, the San Francisco Fed president. Base case for her still apparently something like 3 cuts. 3 months ago, 3 cuts sounded pretty hawkish relative to expectations. And now I have to say, and I said it earlier this morning, now it sounds really dovish relative to how much the market has moved over the last quarter.
And how much the others in the FOMC have moved. Others who are talking about, well, there's no rush. And Raphael Bostic saying 3 last year now, maybe 1 will be enough. I will say what Laureata Messer, though, said yesterday, quote, it's a close call on whether fewer will be needed. That's where we are. Maybe we're going to pencil in 3, but fewer may be needed, and that's what the markets are looking at. But I also want to know from Jay Powell today, will he lean into the labor market or inflation? Jolts yesterday still show pretty tight labor market, but the inflation data we've seen since we last heard from him, whether it's ISM, the uptick in commodities, is that a cause for concern?
Chairman Powell later on this afternoon, I can tell you the first thing I did this morning, I looked at bonds. The second thing I did this morning, I looked at commodities. Brent crude right now up by 0.6%, getting closer and closer to 90, 89.50 on WTI through 85 in the last day or so, 85.70 right now, Lisa, up by 0.6%.
It was remarkable to me that yesterday people were attributing the rally in commodities and in crude as well to demand. And this to me was interesting because a lot of people are talking about possible supply disruptions and what's going on between Iran and Israel. But this is something more with respect to just the slowly tick-by-tick rise in commodities. Taking a bigger picture, we talk about the industrial production wars that we were just talking with Gilles Moek about, how much that fuels the commodity sector in a new way. That is sort of a theme that we keep hearing with Jay Pawlowski basically saying, it's demand, people, go to it.
Is that your Jay Pawlowski impression?
Well, I mean, that's sort of what
Jay,
he was
if you're
saying.
watching, I'm sorry.
Sorry, Jay. But that's sort of, what people are saying out there.
The issue I have is this temporary or is this going to be for the rest of the year? Because even when Bank of America this morning came out and upgraded what they see for Brent and WTI, they see the peak happening this summer, peak driving season. And politically, of course, you're not going to be looking at whether or not the U.S. decides to hit another SPR.
Do you want to do that again? Or you're done?
I think I'm done. Okay. Jay, I'll send you flowers. I'm so sorry. But, I thought I just got emotional and it really inspired me.
I'm waiting for the emails from Jay. Emotional because he's so bullish.
Just because he's just trying to do straight talk.
Okay.
Stop looking at the Magnificent Seven frou-frou.
Sure.
It's going beyond. It's going big. He's into China. I'm curious about how that trade's going.
Yeah.
Anyway, I'd be curious.
Let's talk about stocks right now. Equity futures on the S&P 500. Negative again, but no drama with this move. Just a small move, a mild move lower of 0.15% on the S&P. Yields a little bit higher by a single basis point, 436.12 on a 10-year. Coming up this hour, we'll catch up with Eric Vahl of T. Rowe Price as fading rate cut bets send stocks lower. Ed Morse of Hartree with Brent crude closing in on $90 a barrel. And Michael Collins of PGIM on the sell-off in US Treasuries. We begin with our top story. Good news is apparently bad news now. Better than expected economic data pushing out rate cut bets and sparking a sell-off in markets, setting the stage for comments from Chair Powell later on today. And the US jobs report on Friday. Joining us to discuss is Eric Vahl, the CIO and head of global investments at T. Rowe Price. Eric, good morning to you, sir.
Good morning.
Let's just talk about Chairman Powell a little bit later. Have your expectations for the Federal Reserve this year shifted in quite the same way market expectations have?
We were never as excited about as many rate cuts as the Fed had, as the market had priced in. I think one of the things that really stands out to me is if you go back to what Powell said very early on, He was a student of what happened in the 70s. And if you go back and you look at the mistake made then, it was cutting too early. And if you map the CPI to the very beginning of this cycle versus the last, it's following a similar curve. And if they go ahead and they start cutting now, I think they're in danger of making the same mistakes.
Do you perceive that as the biggest risk then, cutting too soon and not holding too long?
I do.
What would that mean for bond markets if they did?
Well, I think you would see what would happen is the spike up, and then you would have to react to that in a way that would put them on their back foot. And that would lose credibility, and you would have a big issue for them.
I want to challenge one thing that you said, which is that Powell is a student of the 70s. Is he really? Because right now he sounds pretty much like the most dovish member on the FOMC and sounds like he really wants to cut rates. And frankly, a lot of people are looking at that as the reason to buy stocks. Are you saying that they have it wrong?
No, I'm not saying that they have it wrong. I do think he is a student of history, and what he has to do is keep that group, find the middle ground between that group and present it in a way that presents consensus broadly within that committee and balance out the other speakers. So I think he's very much trying to do that right now. But again, I think as you look at the next several months, the idea of cutting when we are where we are from an economic perspective just doesn't, I think, make a ton of sense right now.
Which raises this question, if you do think that this inflation is stickier, and you think that the risk of a 70s type of scenario is greater than the risk of some sort of unforeseen downturn, do you just buy commodities, buy stocks, avoid bonds at all costs? Because right now it's not clear that this FOMC has the conviction to really make the right call and not have a policy error.
Well, I wouldn't go that extreme, right? So as we've unfortunately or fortunately said, we're right now on our asset allocation committee, we're actually dramatically neutral is the phrase that we've been using between stocks and bonds, which is not the most exciting fodder for the media, but that's where we are. I do think commodities, though, is really interesting. And so we are, within our equity portfolios, we're overweight energy in the vast majority of those and in different ways. And we think there are some really interesting opportunities there coming from our bottoms-up work.
Going back to Powell and a student of the 70s, does the commodity pressure, you think, and the increase we've seen unnerve him? Because we heard him say that he can cut quickly if they see labor market deterioration. But you're saying he's really leaning on inflation more than he is the labor market.
Look, I can't tell you I know what's in his head. I do think, though, that in the inflation numbers that we've seen have to give you some pause, right? Just as a reasonable place to be. If you were him, what would you do, right? And I think you have to look at that data.
Do you think we have seen a regime shift post-pandemic versus pre-pandemic? And if you do, how is investing in the next decade or so going to change relative to the previous decade?
Without a doubt, we have seen a regime shift post-pandemic. And the issue is all about the absolute low rates that we had heading prior to the pandemic, where it was much more about the macro, right? It was much more about all things up in a zero environment, risk assets on. In this environment at higher levels, you have to be more, it's much more of a bottoms-up world from our perspective, and it's not as easy in just a chase.
Well, let's get into that because it feels like everything is up so far this year. What shouldn't be up?
Interesting question. What shouldn't be up? We are right now in a position where if you look across our portfolios, we tend to have some overweight positions in a few areas, so mostly in energy and in healthcare. We're relatively neutral in tech, and we've taken some of that from some of the areas like financials and a little bit in industrials where we're a little bit more neutrally positioned.
Well, there's a question here about whether 60-40 works in a new era or inflation's a bigger risk than potentially stagnation or some sort of recession. How much are you shifting away from that with the idea of commodities being more of a ballast than, say, bonds?
We still believe that there can be some benefit from diversification within bonds, for sure. We've also had a strong view that having a real assets sleeve within your portfolio matters and helps and provides really strong diversification from inflation in a way that many of our peers don't do in their asset allocation portfolios. And that's been a differentiator for us. So we have that component, which has been really helpful.
You talk about financials, that you're kind of not that excited about them, which raises this question, if you believe that rates are going to be higher for longer, why not? Isn't that supposedly good for banks? And weren't we supposed to see them both be able to clip coupons, but also with more kind of robust market activity, collect those fees as well?
Yeah, so what matters, though, is the relative valuation of that group. So I think what you just said is right, and part of that's already been factored in. Banks had a nice little pop And we were in there, and now we're taking some of that back. So it's more just about price level than it is about that.
Can I squeeze in a baseball question?
Of course.
Just your thoughts on the new ownership of the Baltimore Orioles.
Super excited.
Good news.
We are both. Look, they walked into Pickles Pub, which is the most important bar in Baltimore, on opening day and bought a round of drinks for everybody. So it doesn't get better than that, John.
They can keep buying drinks. I think they've got deep pockets. Keep asking. Eric, thank you. It's good to see you.
Thank you.
Thank you, sir. And Mike as well.
And Mike, how's it going?
It was actually Mike.
Was it Mike that went around buying the beers?
Yeah.
There we go. Eric Vala, T. Rowe Price, enthusiastically neutral seems to be the phrase coming out of T. Rowe Price. Dramatically neutral.
Yeah, that's the effort.
Was it Sebastian that said enthusiastically neutral?
Aggressively neutral. He said aggressively neutral.
Seb's aggressively neutral.
People are trying to make exciting cases for not necessarily having the boldest of call. Because honestly, how do you get bold at a time where there's so much uncertainty?
I love the idea of Mike going around the bar buying everyone drinks. I love that. Equities right now negative 0.2% on the S&P. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Taiwan has been hit by the strongest earthquake in 25 years. At least 9 people have been killed and more than 900 injured during the 7.4 magnitude quake on the east of the island. Rescue workers are scrambling to find 56 people who remain trapped after the earthquake leveled dozens of buildings. Endeavor Group, the controlling investor in WWE and the Ultimate Fighting Championship, has agreed to be acquired by private equity firm Silver Lake. The $13 billion buyout follows through on plans announced back in October. Endeavor, led by Ari Emanuel, said at the time it was evaluating strategic options out of frustration with the company's declining stock price. Women's college basketball has a new TV ratings record. Monday's highly anticipated rematch between the LSU Tigers and the Iowa Hawkeyes drew over 12 million viewers, according to ESPN. That makes it the most watched college basketball game in the history of the network and tops viewers for last year's NBA Finals and baseball's World Series. Iowa star Caitlin Clark led the way for the Hawkeyes with a dominating 41-point performance on the way to an Iowa win. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the programme, commodities waking up.
We have been saying that we are going to be breaching $90 in the summer. If anything, that's come a little bit earlier. Prices have lagged what the physical has been telling us for a good 3 months now. But now really we are starting to see that catch up.
That conversation up next, live from New York City this morning. Good morning. Live from New York, equity futures just a little bit softer, negative down, lower by 0.14% on the S&P 500. Yields a little bit higher by a single basis point. At the moment, 436.12 is your yield on a 10-year in the commodity market, getting closer and closer to 86 on WTI, 85.79 and positive 0.75%. Under surveillance this morning, commodities waking up.
We have been saying that we are going to be breaching $90 in the summer. If anything, that's come a little bit earlier. We have seen inventories not build or even draw counter-seasonally in Q1. In certain months, the physical market continues to remain very, very strong. And you're just seeing finally that being reflected in prices. Prices have lagged what the physical has been telling us for a good 3 months now. But now really we are starting to see that catch up.
Here's the latest this morning. Brent crude nearing $90 a barrel amid increasing Middle East tensions and expectations that OPEC Plus will keep production cuts until June. Ed Morse of Hartree Partners and formerly of Citi saying this: there is a growing consensus that supply and demand balances are tightening for the next couple of years. There is a tendency to overestimate the demand rebound and to underestimate the supply response around the world if prices get too high. Ed, I'm pleased to say, joins us now for more. Ed, wonderful to catch up with you, sir, in your new seat. Let's just talk about dynamics that are taking crude back towards 90. Ed, what do you think is underpinning this move? Because there's lots of different things happening at the same time.
I think what's underpinning the move is financial markets, to be frank. We've seen increase in call buying. This has happened over time. The market was short at the beginning of the year, given what happened last year, with prices going down at the end of the year rather than going up. Then it became a little bit neutral. And now with the rise in tensions in the Middle East, there certainly is an increase in call buying for Brent. We're seeing an increase in calls at June at 100, July at 110. So I think this is basically the risk factor in the market more than it is supply and demand balances at the moment.
I love this line from you, Ed. There is a tendency to overestimate the demand rebound and to underestimate the supply response. Can we talk about that second line, underestimating the supply response? Can you tell us how strong that Saudi appetite is to withhold barrels from this market as crude gets back towards 90?
Well, the Saudis would love to have a $90 price, not going to 95 or 100, and not going much below that. But you can't really manage a market to that degree. An intriguing thing about OPEC is they just had a seminar, an educational seminar that I think went very well. They had some of the most significant specialists in how derivatives markets work making presentations to them. So they have a much better, not cynical understanding, but a real deeper understanding now of the dynamic effects between financial flows in and out of markets and the balances. So let's hope that they take that to heart. But for your answer on the Saudi question, $90 would be the perfect number if it would be stable for a long period.
You wrote also, this is about as risky a market as one can imagine, and it is only recently that risk is being priced in. Based on what you just said, I'm not completely clear on which the bigger risk is. The idea of so much more supply coming in that prices tank, or that you get demand that continues to be consistent with a possible disruption that causes prices to surge. Which is it?
Well, it's both, and they have different timing. There's no doubt that physical risk in the market is about as high as it has ever been without really massive disruption taking place. We have, looking at the Fragile Five, Iran, Iraq, Libya, Nigeria, and Venezuela, we have concerns about where production will be in all of them. In addition to that, we have concerns about Mexico and Russia, particularly with the bombings by Ukrainian drones on refining capacity. So it's a physically risky market. On the other hand, when we get prices going up, there are changes that take place in the market. China stops buying when prices get above 90, and they start drawing inventories. Their inventories are way, way high. They cover, in our estimate, about 105 days of forward demand. That's as opposed to the 90 days of export cover that the IEA countries have. And they've shown over the last several years that they do buy low and sell high. So we get high prices. China will not be buying from Saudi Arabia and from other Middle East countries as much as they have been lately. We have the U.S., which has already decided to stop the fill of the SPR, which aims at doing that when prices are below 80. And now forward curves have gone up, and they can't buy at below 80, so they've suspended the purchasing. We don't know whether they'll be increasing. We have a remarkable change in the U.S. Market itself in terms of the consolidation of the Permian Basin and other basins. We have large publicly traded companies that won't hesitate to increase expenditures in the short run if they can benefit. So we have high prices in the summer. If they're sustained, let's say for 3 or 4 weeks, I think we'll see the publicly traded companies coming back. And I would not be surprised if instead of an expectation of a 600 to 800 barrel a day, 1,000 barrel a day increase in U.S. production deck over deck, we'll see 1 million, 1.1 million.
Yeah.
We're already seeing U.S. exports skyrocketing. So we're in a very different market where reaction is faster than OPEC Plus has reckoned.
And if you could quantify the uncertainty, I'm thinking of a range. How big is the range that you're looking for in terms of some sort of price on crude as you look to these two-sided risks on all sides?
So I'm looking at a $70 to $95 range. That's a wide range, but that's what we've seen in the market over the last couple of years. We've seen distortions, and as those distortions work out, the market recalibrates and goes down. We had a massive distortion in Suez and in the Red Sea and in flows between Europe and west of Europe through the Suez Canal from the Middle East. That is now adjusting. Freight rates are adjusting. So we're seeing the distortionary impact actually cleaning up even as we move into summer. So it's a much more complicated market than we've ever seen before. And you can't even look at inventories, which is among the most misleading data points that people are now kind of parading out. People are comparing where inventories are now, where they were a month ago and a year ago. That's not the point. The point is that we have to look at inventories discretely. We have to look at them in terms of days of forward cover. If we look even at the U.S., where people argue that we're in a market which is showing tightness on the gasoline side, days of forward cover of gasoline are the third highest of the last 3 years. So it's not like that's like more of an average market than it is like a market with low inventory. So we've got to get used to a new set of indicators as we look at markets and help us make judgments about where prices are likely to go and where the trading community should be going.
Ed, we talked a lot about supply. I want to talk to you about demand, because you have a contrary view in terms of you actually see peak demand happening in advanced economies. Why?
Well, it's easy if you look at them one by one. The European economy has certainly been deindustrializing at a fairly rapid rate. They've adapted policies at a fairly rapid rate to reduce the number of fossil fueled trucks and cars, and demand across Europe. We don't have high-frequency data that really tell us much. We have high-frequency data from Mediterranean countries, which are in a healthier mode than Northern Europe, where we have a 2 to 3 month lag. So even IEA data lag in terms of high frequency, other than in areas like Amsterdam, Rotterdam, where we get high-frequency weekly data on inventories, but not on critical supply and demand. On China, as I remarked to you in the notes I said, we have high demand on a year-on-year basis. But if we look at the last 6 to 8 months, demand has really plateaued. And that goes along with everything we know about the Chinese economy, what we know about EV penetration into the economy, what we know about growth, which I think is, again, one of the most misleading indicators. We have China claiming they had 5.3% growth. We have the IMF indicating China this year will have over 5% GDP growth in China. The reality is that if you talk to Chinese specialists and Chinese economists in China, they will tell you on the side that GDP growth was not 5.3% last year. It was more like 2.5% at a peak and might have been even lower than that. So we have GDP that's stagnating. We have incremental buying pushed by the government of electric vehicles, displacing fossil fuel vehicles. And then in the U.S., if we look carefully at gasoline demand year to date, we had with January close to final data, virtually no demand growth. It was stagnant year on year. The same is true of February on a 4-week moving average basis for the data we have for February. And we'll get a third week of March in the data later this morning. But yes, we did have an increase in gasoline demand in the last 4-week moving average numbers. And we'll see how sustainable that is, how seasonal that is. But what it is more than anything else is kind of a misleading number compared to the historical level that we've looked at over the past several months.
Ed, when I get home later, I'm going to re-listen to this conversation. Really, really interesting. Ed Morse there of Hartree Partners on the commodity market. Brent crude at the moment, 89.60. Lisa, 85.82 on WTI.
Most dangerous market he's seen in a long time, given that there are very two-sided risks and hard to really get a gauge with new metrics kind of signaling how to look.
Coming up next on this programme, President Biden escalating his criticism of Israel following the deaths of 7 aid workers. That conversation is coming up next with US Marine Corps veteran Elliot Ackerman from New York. This is Bloomberg. TK just messaged in. He said on Bloomberg Radio they're doing soccer talk. Tots Aston. Just after I did baseball talk. So if you want the American talking about British football, radio. If you want the Brit talking about baseball, TV.
Makes sense. Perfect.
Perfect sense.
Yeah.
Perfect sense.
Thanks.
Equities right now on the S&P 500 negative by 0.1%. On the Nasdaq, we're down about 0.2. The Russell trying to bounce. The small caps up by about 1/3 of 1%. Yesterday, Lisa, difficult day for the Russell and the small caps.
Which challenges this idea that you can get a rotation into other non-tech sectors if you do have higher yields. Again, this perhaps has been the week that stocks have woken up to the risk of potentially significantly higher yields than we've seen so far this year.
Begs the question why they've been asleep through the whole of Q1, but there we are, asleep to this. A repricing in the bond market, a 2-year getting closer again to about 470 at 469.73 across the curve. We saw new highs for 2024, yields higher by a basis point or two, just short of 440 on a 10-year. Considering where we were last week, we closed out Q1 at 420. So this is quite a move over the last 3 days.
Which begs the question, and you frame it well, saying basically, what took so long? Why have they been asleep? And is there a trigger point at which yields start to matter and be restrictive to the market? Is the market trying to sort of game out what a restrictive rate actually is at a time that everyone has been surprised again and again by the strength of the U.S. economy? Because at this point, we don't have an understanding. Market Patel saying it doesn't matter. This rate hiking cycle hasn't had any influence whatsoever, and that long and variable lags essentially is hogwash. So this, to me, raises this question of, is this market trying to game out how true that actually is?
I've got a question for you. The difference between what's happening in the commodity market and what's happening in the bond market right now. Can we just quickly pull up what's happening with gold? So gold's pulled back just a touch, but we've seen recently all-time highs. Lisa, the relationship between gold and Treasury yields and how it's developed in the last few weeks or so, is it strange to see yields break out and gold break out simultaneously?
It begs the question about whether I don't want to make a too dramatic statement saying that the U.S. has lost the privilege to borrow and act recklessly. But is there a concern that the U.S. cannot have the same kind of haven status at a time of inflation if it's borrowing money and has a fiscal overhang and a deficit that's as big as it is? I don't want to make this too, sort of definitive because I don't know the answer. But it raises this question about the fiscal picture possibly coloring the haven asset worthiness of bonds. Maybe gold acting like that a bit more.
As an inflation hedge, but also the fact that the Fed speak continues to say they will cut, which is going to mean potentially these precious metals will go higher. But Lisa, your point earlier, precious metals are also going higher because metals in general are going higher because we're seeing manufacturing pick up on a global scale.
Really interesting what's happening right now between commodities and bonds and how that's spooked equities in the last couple of days. Let's get to under surveillance. Our top stories this morning. The slew of Fed speak continues today. Bostic, Bauman, Goolsbee, Barr, Kugler, all on tap. Chairman Powell, the headline act. Fed officials sticking to the script this week in the face of stronger than expected economic data. Any reason for Chairman Powell to change his thoughts later on this afternoon? We had one explanation yesterday that said that perhaps you get a difference between what you heard in the news conference, attempting to reflect the broken consensus maybe, and the man himself to get his opinion later on.
So I have such little conviction that he's going to say anything different that I find the actual forum more interesting than the potential for him to act dovish or hawkish. He probably will continue with his tune because, frankly, he has, regardless of how hot the data is, the fact that he's speaking alongside the CEO of Google and Alphabet at the Stanford Business, Government, and Society Forum, to me highlights really how challenging his position is. Does he hint at that productivity boom that we're expecting to see? Does he hint at some of the transformations that give him confidence that we are going to see inflation trend lower, even though we're not seeing weakness in tandem?
I'm more interested to hear Raphael Bostic said. He has said he was 3, 1. Is he now 0 when it comes to rate cuts this year? And how much is what he's talking about potentially going to influence other members of the Fed?
I just love the bias on the FOMC, and I think you did a brilliant job, Lisa, as going back over the show, just sort of exposing that bias. They talk about being data dependent, but any data that's not in line with their thoughts, they just call bumps in the road. So how data dependent are they actually?
How can you be data dependent when one analyst company says that basically the data that we're going to get today is deeply unreliable? I mean, this is a really difficult moment.
And you're relying on it to explain that you're sufficiently restrictive.
We're dependent on that data. It's also deeply unreliable. That's where we're at right now.
OK, let's turn to this story. Elon Musk deepening his feud with Disney's Bob Iger, throwing his support behind Nyson Pouts. Even as the Triad CEO appears poised to lose a proxy battle with the company, Musk saying Pouts should, quote, definitely be on the Disney board. Weighing in hours before a shareholder meeting over Pouts' proxy fight, Musk has repeatedly criticised Iger after Disney pulled the advertising from the social media platform X. Disney shares so far this year higher by something like 35%. The latest reporting from Reuters overnight, Lisa, and I'll read out our lead paragraph. Disney has secured enough shareholder votes to fend off a challenge from Nelson Peltz. That according to Reuters, citing people familiar with the matter.
With the backing of JP Morgan's Jamie Dimon, who actually came out behind the Disney board. There are two stories here. There's a Disney story, and we can get into that, but there's the Elon Musk story. And this real question that I have about how much some of his bold stances are working against Tesla, or if he's ramping it up because that is what's defined him and gained so much publicity. I mean, really, this is sort of one of the key questions in sort of a company and a personality that's driven so much attention.
But no surprise there. He's almost adding fuel to that fire and that tension. He had some interesting choice words, which I'm not going to say on television. We know for Bob Iger, but he also said last December that he should be fired. So basically what he's saying is if you act on that, maybe I'm a buyer.
We've given him a platform on pretty much everything, haven't we? Doesn't Kara Swisher complain about this, that once someone becomes hyper-successful in one field, their opinion seems to matter on pretty much everything?
Yes, however, he also has gone into pretty much everything, considering the fact that he bought Twitter and the fact that he's in space exploration and cars and whether he's renewable energy. I mean, what is he in?
And going down to Palm Beach and exerting himself in the immigration debate and the U.S. presidential debate. He puts, to Lisa's point, he puts himself there, which is almost why journalists have to ask.
Well, he's free to say whatever he wants about whatever he wants. Without a doubt about that. It's just interesting to me that journalists do go after absolutely everything he says about absolutely everything. Why is it relevant what Elon Musk thinks about who should be running the Walt Disney Company right now? Why is that highly relevant?
Because it sells and people click on it. I mean, honestly, that's a big part of it. Also, potentially, he's got deep pockets, but ultimately, that's what it comes down to.
True. Let's turn to this story. Tensions between the US and Israel rising after President Biden said the country hasn't done enough to protect civilians following the death of 7 aid workers in an airstrike. Israeli Prime Minister Benjamin Netanyahu calling the strike unintentional, but Biden saying incidents like that, quote, simply shouldn't happen. Joining us now is Elliot Ackerman, US Marine Corps veteran and a former White House fellow. Elliot, wonderful to catch up with you, sir. A conversation we had yesterday I'd like to build on with you this morning. Do you think we overestimate the influence that America has on Israel?
I think in some ways we do, and in some ways we seem to assume that if the U.S. distances itself from Israel, that is going to cause Israel to, in some way, be cowed or to de-escalate the war, when in fact it could have the exact opposite effect. If the U.S. distances itself from Israel, it could make Israel feel only more isolated and feel as though this war is only more existential and cause them to escalate the war in ways that are unexpected to us.
It feels like the growing acrimony between Netanyahu and Biden has reached really fever pitch and there's no going back. But broadly speaking, between Israel and the United States, do you think this is a new chapter in that relationship?
I think in the last couple of weeks, we've certainly seen, yes, what I would characterize as a new chapter in which, the U.S. is not just going to be unequivocally supporting all of Israel's actions. But I think that has second and third order effects for the U.S. and our ability to have a real voice in the direction of the war. And I think, again, counterintuitively, it could lead to an escalation of the war.
When you're looking at some of the reporting that came out of that strategic meeting between Israeli officials and U.S. officials, one place where they don't seem to agree on is how to evacuate those civilians and how long it would take. Elliot, given all your experience, how do you assess that situation?
It's extremely difficult to operate on these types of urban battlefields that we see in Gaza, in which your adversary, in this case Hamas, is hiding among the civilian population, using the civilian population as cover. And that's a very deliberate decision on the part of Hamas since the outset of this war. Evacuating the civilian population is also extremely complex because wherever you evacuate civilians, you're also going to be evacuating Hamas fighters who will blend in with them. So this is extremely difficult to do, if, perhaps even impossible, because the fighters need the civilian population. So when you move civilians, you're also by definition going to be moving fighters.
Do we have a sense of what's left of Hamas and who the influences are? Is Iran still working with Hamas in any kind of way? Are there still talks ongoing with key members that are not only alive, but still in command?
Yeah, I think, the key leadership of Hamas that is living in exile continue to live in exile. And sort of the second and third order commanders who are on the ground in Gaza are, frankly, replaceable. And, we saw this in the American experience with al-Qaeda. We launched a 20-year campaign to destroy al-Qaeda, and we were very effective at destroying sort of the second and third tier commanders. But the challenge was every time that you kill these people, they are replaceable and will be replaced. And that's what we're seeing right now happening in Gaza with Hamas. And it's why this war is so difficult for Israel, particularly when they've staked the objectives as the destruction of Hamas. It's very, very difficult to completely eradicate a force like Hamas. And again, that adheres to the American experience with al-Qaeda.
Which is the reason why I think a lot of people are trying to understand what the signal is from Israel's attacks on senior officials of Iran. Is this the next phase in trying to get to the root of the issue and sort of laying the groundwork for an incursion to Israel's north in Lebanon against Hezbollah?
Yeah, I think it's difficult to say. We talk a lot about Hamas, but what we don't talk quite as much about is the threat that exists to the north with Hezbollah, and that if, Hezbollah were to actively enter the war, I mean, they're already somewhat active on the northern border, it would change the parameters and the scope. So it's difficult to know whether or not this strike against Hezbollah and against Iran was, in preparation for further action on the part of Israel, or if perhaps it was a target of opportunity, and Israel saw the opportunity to strike to strategically target these Iranians and just made good on it.
What do you see as the likely route Iran will take in terms of their revenge on Israel for the killing of these IRGC commanders in Damascus?
Well, it's important to remember that there is a difference between expressing a desire to take revenge and to having the capability on taking a type of meaningful revenge. Case in point was the death of Qasem Soleimani, in which Iran vowed revenge against the United States. And that revenge was pretty tepid. They fired a few missiles at our bases in Iraq, and that was the end of it. But that being said, I think the Iranian leadership is going to need to be seen to take some type of revenge, and I think there's a very real chance that revenge could come against Israeli targets abroad, and I imagine the Israelis are preparing for that.
When you say targets abroad, Elliot, what kind of targets? Can you give us a little bit more color on that?
Sure. Diplomats, targeted assassinations, facilities abroad. Iran is a terrorist state, and we should expect that their response will be asymmetric. Some type of action that seems, almost like a terrorist attack. I'm not saying that's what will happen, but those are the types of responses that we can anticipate. As opposed to seeing some type of revenge operation, on the battlefield in Gaza or in Israel itself, which frankly would probably sort of just get lost in all of the noise and violence that's going on right now.
Do you think they go so far as to do that on U.S. soil, Elliot?
No, I don't. I think that is the degree of escalation that they probably don't want to enter and would bring the U.S. more directly into the war in ways I think would be extremely uncomfortable for Iran. And again, I'm not trying to predict this. I'm saying these are probably the range of options that the Iranians are looking at. And then that also goes up to the point of, do they have the capability to execute that type of a revenge operation successfully? So a lot of questions here, and a lot of uncertainty on what that reprisal is going to look like.
Appreciate the framing. Thank you, Elliot. Thanks for your time, sir. Elliot Ackerman there on the latest and just how Iran's going to respond potentially to this.
And what we know from Iran is that they like to respond via their proxy groups. So it's Hezbollah, it's the Houthis. These are the kind of places potentially. I mean, he's going as far as to say really outside the realm of Israel, foreign and other places, but also Israeli ships, potentially outside Red Sea in the Indian Ocean. But to his point about what happened with Qasem Soleimani is fascinating. They responded, it was tepid because the back channel talk to the Trump administration was, we don't want to start a war.
That's the latest on the Middle East. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Herkes. Hey, Yahara.
Hi, John. U.S. regulators led by the Fed have blocked tough global climate risk rules for U.S. banks. This comes as European central bankers have been advocating for the Basel Committee to agree on requiring lenders to reveal how they plan to meet green commitments. But in closed-door meetings, U.S. officials have cited their narrow mandate and aired concerns that the Basel Committee is overstepping its purpose. President Biden and former President Trump both added to their delegate counts last night. 4 more states held primaries on Tuesday, and the presumptive nominees easily won in New York, Connecticut, Rhode Island, and Wisconsin. Trump picked up 78 to 84% of the Republican vote, while Biden took 83 to 91.5% on the Democratic side. And we're also talking about football here. Tottenham Hotspur is in talks with potential investors over a stake in the English football club. The club's board beginning talks after stating it, quote, requires a significant increase in its equity base in order to invest in its teams and take on future capital projects. In an interview with Bloomberg last year, Chairman Daniel Levy revealed the club was open to selling a stake and had received offers in the past from the Far East, Middle East, and America, but none were of interest at the time. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, bond traders facing up to high for longer.
I continue to think the most likely scenario is that inflation will continue on a downward trajectory to 2% over time, but I need to see more data to raise my confidence.
That conversation just around the corner, live from New York. This is Bloomberg. Update on the commodity market, 85.90 on WTI right now, close to 86, getting closer and closer to 90 on Brent crude, up by 0.9%. Moments ago, Bramo, an update from OPEC Plus.
Basically saying that they're going to stick with their supply cuts that they had planned for the first half of the year, keeping basically the pressure on. And this raises the question, are they enjoying prices that are higher at a time where potentially some of their companies, state-owned companies, are looking to raise some more money?
They're not just sticking with the cuts. To the cheaters out there in OPEC Plus, they're renewing the request for better compliance with those cuts. So if you're not hitting them, ratchet back even more production, please, and stay in line.
Just inching closer and closer to 90, up by close to 1% this morning. Under surveillance this morning, bond traders facing up to high for longer.
I continue to think the most likely scenario is that inflation will continue on a downward trajectory to 2% over time, but I need to see more data to raise my confidence. Some further monthly readings will give us a better sense of whether the disinflation process is stalling out or whether the start of the year readings reflect a temporary detour on the downward path back to price stability.
Here's the latest this morning. A Treasury sell-off keeping US yields near highs of the year as hopes for a June rate cut continue to fade. Michael Collins of PGIM saying this: the Fed's own projections indicate a policy rate of nearly 4% by the end of 25, leaving a narrow margin of error for a 10-year yield in the low 4% area. Given the incoming Treasury supply and inflation that remains above target, Michael Collins, I'm pleased to say, is with us right now. Michael Collins, did I just hear a little argument there for higher bond yields?
You know, Jonathan, just think about it. If you're the Federal Reserve, why would you even think about cutting interest rates when the economy continues to be really solid? Inflation, as we just saw Loretta Mester say, continues to be sticky and well above their target. The labor market is still rock solid, if not outright strong. The stock market has been hitting new highs. Credit spreads are new lows. Financial conditions are the easiest they've been since just after the Fed started hiking. Why would you cut interest rates with that backdrop, right? So their MO is to sit on their hands, really not do anything until they have to, until one of those indicators starts to crack, right? And we're looking for signs that those indicators are cracking, and they're just not there yet.
So if I called you this morning and said 10-year 437, 30-year 452, would you like some? You'd say no?
You know, we're actually short a little bit, like the very front end, the 2 to kind of 7 year part of the curve, because that's where all those cuts are priced in over the next year or year and a half. But Jonathan, over the long term, we're sticking to our guns. I'm looking at the 20-year today at 460, and this is what we're advising our clients. If you have a long-term time horizon, 3 years and out, you're supposed to buy long-term interest rates here. There is value. They'll probably be lower in 3 years from now, but it's really the next 6, 12, 18 months that we're hedging our bets.
How much is that complete faith that the Federal Reserve will be overly cautious in terms of how quickly they'll cut rates? In other words, if they don't really follow through on that and they do cut rates in June, despite some of the strong data, would you move away from that long duration view?
No, I think if they cut rates sooner, it even emboldens the view that those long-term interest rates in the mid-4s are too high, right? Looking at the 5-year markets pricing of what the Fed funds rate is going to be, Lisa. So that's like a really term expectation of the funds rate. It's at 380 today, all right? So the markets are only pricing in about 160 or so basis points of cuts forever. right? And that's really why we have a stronger viewpoint on the longer term value in Treasury yields right now, because I think the Fed funds rate is probably going to average well below 3.8% a year for the next 10 years, right? And we're just really debating, the next 6 to 12 months. But wow, over the long term, global growth is slowing. China is really struggling. You're seeing inflation in Europe continue to decelerate, right? So, there are big picture signs globally that growth is going to continue to moderate and that inflation will ultimately come down. It's really the challenge has been in the U.S. data.
Which is interesting because this is one of the key nodes of debate, which is basically, are we in a new regime post-pandemic of higher inflation? Or to your point, are we not? Would a possible policy shift change that? The potential for a more aggressive protectionist type of policy with higher tariffs and more sort of nearshoring and onshoring of production?
Yeah, the world, Lisa, had been pricing in, and according to our models, the markets were pricing in almost 100% probability of this really, weakflation, soft landing scenario. And we thought, that was too aggressive, meaning risk assets were maybe too ebullient, too optimistic. One of the big risks to that scenario is obviously heightened geopolitical risk. As you point out, the political reaction to that, the stickiness of inflation associated with that. And you're seeing, obviously, things like oil jumping here, but even some of the commodities that have underperformed, like lumber, natural gas, iron ore, are bottoming out here. So you could have this kind of bounce in commodities associated with some of the geopolitical risk, which leads to stickier inflation, which leads to a Fed that is forced to hold rates higher. And to us, that's a risk to the markets. That's a risk to the economy. That's a risk to credit spreads, if you will.
Well, let's talk about credit spreads. High yield spreads, a little bit wider, still in at around 300 basis points, near multi-year tights. Mike, a question we keep going back to on this program, is that tightness a reflection of strength or complacency? How would you describe it?
It is a little bit of both. The fundamentals, Jonathan, in the credit markets, the fundamentals of corporations around the world are actually still really robust. We've expected profit margins to really come down. They really haven't. Profitability isn't great, but it's okay. Companies have done a really good job managing their balance sheets and their liquidity, and these higher rates really haven't hurt them so much. Credit default rates are not going to surge in our estimation. It's hard to say spreads are cheap here. It's probably even hard to argue that they're fair value, but we have seen in past cycles, and I've certainly lived through a lot of these, where credit spreads narrow, and they stay at these really narrow levels for a long time, years in some cases, and who knows, we might be in one of those environments. But we also have learned that the tail risks are significant, that when credit spreads do widen, they kind of spike wider, and it could be any exogenous shock out of the blue, including the risks I just mentioned. So it's definitely prudent to cut risk here. We are doing that. We are selling into this rally. We've been doing it for a while, continuing to play defense to some extent in the credit markets. But one thing you're seeing, Jonathan, with these credit spreads, Treasury yields are high, right? The premium of a Treasury bond over SOFR, which is theoretically the real risk-free rate, is very high. So there's already this big supply premium in Treasury. So maybe it's the risk-free rate that's too high, and the corporate bond yields are at the right level. So I think the spread, there's this technical aspect to it, right? There's a ton of supply of Treasuries and not a lot of supply of private sector credit debt. So that in and of itself causes these credit spreads to remain narrower than you would expect.
Mike, this was a clinic. Next time, get in a car, go through the tunnel, get from New Jersey to New York, and we'll do this around a table for a whole lot longer. Michael, thank you, sir. Michael Collins there of PGIM. Love it. Thank you, buddy. Absolute clinic. Coming up on this programme, up next, Steve Weidiger, Citi, former House Majority Leader, Eric Cantor and Mandeep Singh of Bloomberg Intelligence, the third hour of Bloomberg Surveillance. Up next.
The Fed is telling us that inflation is still a problem. It's going to be less rate cuts relative to what the market was expecting.
I think the Fed have been really clear that they're looking for progress on inflation.
Not only has the market moved away from a Fed cut in June, the market's not even fully pricing in the cut in July.
Actually taking no action right now is probably the best course of action for them to take instead of making a mistake.
They want to give the market what it wants in the form of easier policy, but the risk is overdoing it to the downside.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Quote of the morning, nothing comes close. Nothing will beat this. From Michael Brown of Pepperstone FX on Twitter. ADP due shortly, so we can all see what the NFP number won't be on Friday.
Which is the reason why we are...
ADP, just around the corner.
Yeah, we heard that from Pantheon Macro as well, right? Deeply unreliable, which is what we're going to wait for when people start to trade on it. We'll explain why.
What is it about pouring cold water over labour market data at the moment? Andrew Honhorst of Citi out with this note. Jolts bring little new information. ADP out this morning, not a reliable indicator. Going into payrolls on Friday.
Because when we get the data, everyone afterwards explains why it doesn't matter and why it's relevant and why their theses still stand. Again, this goes to this question of if you have an ultra data-dependent Federal Reserve and then everyone discounts the data, what are we really hinging a lot of our ideas on?
The only time it ever really gives a good preview to NFP, it's totally off of coincidence, but the Fed uses ADP data for their own private statistics. So in that sense, I do find it slightly interesting.
Citi does say this, important to look at the ISM services and employment subcomponent coming out a little bit later today. And they're looking for this on Friday. And I think we need to get into payrolls Friday just a little bit more this Wednesday. They're looking for a below consensus 150,000 job growth on Friday. I think this is really important. Over at Citi, they believe the emphasis has shifted to a greater degree away from inflation and towards payrolls on the FOMC.
And they've been expecting weakness for quite a while. And they pointed to the fact that Loretta Mester, who has traditionally been of the more hawkish ilk, coming out and still supporting 75 basis points of rate cuts, even if she says that she needs more information. It seems as though there is a cadre of people, including most of the people on the FOMC, that believe that we will see weakness and that believe that we are starting to see signs of it in certain corners with quits rates that are at the lowest levels going back to 2019, although, pretty much stable. I'm just struck by how much disagreement there is on the basic structure of where we are, whether it's Margie Patel, New Era, Michael Collins, Nope, Ed Morse, riskiest time ever, huge range, Eric Riel, basically enthusiastically neutral. It is a confusing moment where people really are not getting their handle on any kind of consensus of the new normal.
Confusing, so it makes it hard for consensus. But going to payrolls on Friday, Jonathan, you brought up a great point. What is deterioration in the payrolls market? If it's a two-handle, how can they say that is deterioration in the labor market and give them an impetus to want to potentially cut rates?
200 looks pretty rock solid to me. 214 surface level stuff looks pretty solid. Hard to disagree with that. The previous number 275. Sometimes the news is that there isn't any. And I think on the FOMC, that's what strikes me about the communication so far. There's been no change from them for 3 months, even though you've seen this big swing, this massive squeeze develop in the market. They've barely moved at all. And just the way I responded to listening to Mary Daly yesterday, just sitting there, and I've repeated this a few times this morning, I know, but I was sitting there yesterday listening to Mary Daly talk about 3 cuts in 2024, and I just thought, wow, super dovish, 3 cuts for 2024. 3 months ago, I'd be sitting there saying, 3 cuts compared to where this market's at? How are we going to close that spread without causing all this damage in the market? And here we are. Stock's still just off all-time highs.
I want to offer up an apology because I've gotten a lot of messages from people saying it's you that have been wrong in terms of the whipsawing of the, oh, my goodness, they need to cut 7 times to, oh, my goodness, they're not going to cut it all. The Fed stayed the same and they've been right, and the market's kind of moved toward them. As Mary Daly said, it's a projection. They change with the data. Of course, now we're undermining with this question of the data. So the labor market report will be one data point that we will be watching.
Yeah, they say they change with the data, but you said every single data point is just recalled an aberration or a bump in the road if it doesn't suit the trend or the thing that they're looking for. And I take issue with that at the moment.
I would agree with that. I also think that some of the manufacturing resurgence that we're seeing has to get their attention because we were expecting manufacturing to remain suppressed and then services to come down and meet it. And we haven't necessarily seen that to the same degree. If you have manufacturing inflation picking up and services inflation kind of remaining sticky, that creates a hairier situation.
And it's not just manufacturing at home, it's manufacturing abroad as well. China too. We'll get to the commodity market in just a moment. Equity futures at the moment trying to recover, just about unchanged on the session on the S&P 500. Brent crude and WTI starting to move higher. A move of 1% on WTI. We reclaim 86. On Brent crude, 89. 82 this morning. Annmarie, crude bleeding higher again by 1 full percentage point this morning.
Yep, 1 full percentage point. This comes on the heels of not just the geopolitical risk we've seen into the market the last 48 hours, but OPEC Plus. We're not going to add any more supply to this. And they went a step further. Those cheaters out there, please come in line with what you agreed that you were going to cut in terms of supply. Fascinating going to the summer when you're going to have peak demand, Jonathan. Are they going to have to come in and help support this market?
That move in crude pushing yields up a little bit as well, up an extra basis point. The 10-year getting closer and closer to 440. Bear in mind where we closed out last week at 420. Closing out Q1, 420. Just a few days into Q2, very close to 440. Coming up this hour, we'll catch up with Steve Whiting at Citigroup on why he thinks this is close to an ideal setting for financial markets. Former House Majority Leader Eric Cantor on the ballooning US deficit, and the brilliant Mandeep Singh of Bloomberg Intelligence after an earthquake strikes the global chip-making hub of Taiwan. We begin with our top story. The rally that took stocks to record highs is taking a breather as rate cut expectations continue to fade. Steve Whiting of Citi Global Wealth saying this: the combination of lower policy interest rates, slowing inflation, uninterrupted economic growth and rising corporate profits is as close to an ideal setting for financial markets. Steve, I'm pleased to say, joined us now for more. Steve, let me go through that quote again. So this is what you said: lower policy rates, slowing inflation, uninterrupted economic growth, rising corporate profits. Close to ideal. Couldn't agree with you more. But is that what we have right now?
That's what explains the last 6 months. That's what explains a 24% rally, over the course of 2 quarters. So that's what we want everyone to bear in mind, that we've had this really, really strong run with low volatility. We've checked the boxes on that whole list. So naturally now there's some more doubt. Again, we could talk about what the Fed actually does, what data they will require. We can zoom out a little bit, but it's a little bit more natural now for us to develop some doubts about, this very, very perfect path that we've been on.
So, Steve, how does that sort of doubt get expressed in your view if you think that ultimately we do see a pretty strong backdrop and ultimately this sort of perfect landing, this disinflation nirvana will continue?
Well, I think, again, the rates market having a bit of a backup here, we think that long-term treasuries, again, very efficiently priced in Fed rate cuts. And at the high of this year, they're pricing in almost 7 rate cuts this year. Now they're going all the way to having doubts about any cuts this year. In reality, the Federal Reserve has clarified, again, with its forecast, with its history, that it doesn't need, again, a collapse in the economy to move back from highly restrictive monetary policy to a more neutral setting, given some time. And that this is not a crisis that it's going to take for the Federal Reserve to cut a little bit. But the market's got to digest this. And the fact that we've had predictably a higher inflation for the first 2 months of the year, and there was no reaction to this. Now, again, a little strong data, and we take a little bit of wind out of the sails of the bond market, and then this feeds through to the equity market. So again, it wouldn't be surprising if the equity market feels it a little bit more. Again, in terms of strategy at Citi Global Wealth, we've moved a little bit more towards areas like healthcare that are not quite as reliant on really, really low interest rates. I think, to power valuations higher. And nor have we gone and really added even more to cyclical industries, which have rallied on expectations of growth. So that very, very good backdrop we've had, we could have been even more bullish. And we're just tempering that a little bit here and holding in.
Steve, I'd love your take on what we've been hearing all morning, which is completely different views on where we are going to settle in terms of the post-pandemic norm. And I just want to get your view about whether you view that disagreement as healthy and encouraging your view, or whether it kind of keeps you up at night. That what if we are in a highly inflationary environment in the post-pandemic reality where rates are not going to come down all that much versus going back to what we were used to pre-2019?
Well, look, if it was a highly inflationary environment where we have a truly overheating economy, where the labor demand just exceeds supply at an accelerating level, we'll find a way to have a recession then. And I don't think that's going to be the case. When you shifted to a bullish posture on the outlook for financial markets, and then you see the consensus that, again, very much believe that we had to have an economic downturn and everybody get even more bullish, then you start to say, well, the problem is a bullish consensus. Now that we're hearing some disagreement, we're hearing all of these troubles arise that people are are thinking, imagining, I think it's a little bit helpful here, again, to take out a little bit of the froth. The reality is that to get the continuation of this 10% per quarter type of rally in the S&P 500 would take even more positive surprises. It would take a larger drop in inflation and a stronger rebound in growth and profits. I think we have a pretty good picture, but we don't get to do 24% of 6 months, annualized 48%.
Steve, you talk about the possibility, though, of a near-term CPI surprise. Potentially that could be then a pullback of what we're seeing in the market. How concerned are you about the uptick in commodities influencing a surprise in CPI, that we do see a reacceleration?
So look, I think headline inflation had a nice assist from oil actually peaked way back in early 2022, again, with the invasion of Ukraine. And we've had some ups and downs. These are familiar ranges. It certainly won't give us any near-term help on a headline CPI. I think that measured inflation, this piece of shelter that's still up 6% year to year, where the inputs for that looking 1 year out are coming down sharply. That's going to give us a year of measured core disinflation, particularly for the CPI reading, a little bit less for the core PCE. But that's going to be, I think, when realized, now that everyone's worried about inflation again, healthfully, that's going to give us, I think, a little bit of calm on the inflation front. What I think is really critical here is the employment pace. Just zoom out a little bit. I'm going to use rounded numbers, but if you go back to 2021, we did almost 7 million job gains as the rebound from the pandemic. We then slowed to 5 million. Last year, rounded, we slowed to 3 million. That slowing, I don't think, is going to stop. What we've seen with job openings, high levels, well, they're down 3.4 million. If you think about monetary policy with, the high end of the Fed funds rate at 5.5%, and the job market slowing, where will it be 6 months from now? It's slower than it has been. And I also say that these quarterly distortions, employment and inflation data, some of it, not the commodity prices, but pieces of the inflation data and employment data have been biased up by some difficulty with seasonals at the beginning of the year. What we saw in production and demand data biased down. I think that this can, again, move more favorably as we get into mid-year. And if we do get, again, a little bit more restraint on the employment front, we will calm down the bond market. Now, if that creates some worries in the stock market, maybe there'll be more opportunity after we get through that.
Interesting. Steve, we've got to leave it there. I know we've got some technical connections. We're going to work on your shot in the next few minutes, so don't go anywhere. Steve Whiting there of Citi is going to be sticking with us. Looking for some jobs data in just a moment. The ADP report, 150 is the estimate. The previous number, 140. Going into payrolls Friday, the estimate there for you in our survey is about 214. The previous number, 275. Let's give you an update on stories elsewhere. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Taiwan has been hit by the strongest earthquake in 25 years. At least 9 people have been killed and more than 900 injured during the 7.4 magnitude quake on the east of the island. Rescue workers are scrambling to find 56 people who remain trapped after the earthquake leveled dozens of buildings. Intel shares are falling in pre-market trading after it reported losses at its factory network, saying that losses have deepened and the business may not reach a break-even point for several years. A new division at the company, dubbed Intel Foundry, which is responsible for manufacturing, recorded an operating loss of $7 billion in 2023. That's more than the $5.2 billion it posted the previous year. Sales also fell short at the unit with $18.9 billion recorded in 2023. That's down from $27.5 billion the previous year. Women's college basketball has a new TV ratings record. Monday's highly anticipated rematch between the LSU Tigers and the Iowa Hawkeyes drew over 12 million viewers, according to ESPN. That makes it the most watched college basketball game in the history of the network. It also tops the viewers for last year's NBA Finals and baseball's World Series. Iowa star Caitlin Clark led the way for the Hawkeyes with a dominating 41-point performance on the way to an Iowa win. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the programme, ADP payrolls data ahead of Friday's main event.
We're probably going to see a somewhat slower growth rate in the job market. We're in a soft landing, but the overall trend in inflation is still going in the right direction, and that's the strongest argument for buying, extending duration.
The data up next. Economic data out just moments ago. It's an upside surprise on the ADP report. Mike McKee, what have you got?
184,000 jobs were created in the month of March, according to ADP, at least, most of those in the service-producing sector. What's interesting is this is not only higher than the forecast of economists for ADP, it's higher than the forecast for jobs in the private sector for the payrolls report on Friday. Right now, we're looking at a private payrolls number of 170, so 184,000 is 14,000 more than economists were anticipating. Wonder if, given what we saw with ISM number changing people's views of Friday's total, whether we'll see that happen again, whether we get some upward revisions after this.
The median estimate in our survey has been creeping higher, Mike. It's got to 214 from 200K, I think, to start the week. Do you think that was ISM manufacturing just sort of waking everyone up on Monday to maybe a bigger number?
Well, you put that together with JOLTS and the fact that there were a lot of job openings. That's probably why we do get the ISM services numbers today at 10 a.m. That'll be important in terms of the number for their jobs index, and we could see this all revised up. We have been running a number of months in a row with numbers coming in higher than the Fed forecasts.
Welcome to Existential Wednesday, where we start to question what the data means and whether it's relevant, because that's exactly what we get from a lot of notes after it comes out, where people say, yeah, but this is a reason why you can discount it. What do you make of all these people saying, okay, well, the ADP is messy and noisy and never predictive. We're going to get the same kind of messiness with ISM services. You could say that about JOLTS, and yet quietly under the surface, people are starting to trade with this expectation of more strength ahead.
Well, the traders are putting it together the same way the economists and perhaps the Fed are putting it together. You don't make a decision based on any one number, but when everything is coming into the same area, you know, it's the wisdom of crowds, I guess, wisdom of crowds of data, as opposed to the wisdom of crowds of people, or the old 50 million flies can't be wrong.
But do people say that the data now is less correct than it used to be, simply because of a lack of survey responses, because of transformed demographics, because of different ways that people communicate? And I don't mean to get too abstract, but I just gotten so many notes over the past 3 days challenging the accuracy of all of the data that we're supposedly dependent on, and I'm wondering whether that rings true to you.
It does. There is a problem with the response rates we're getting from a lot of the data points, and people just don't like filling out surveys anymore, it appears. It's the same problem they have with the political polls. But the statistical agencies are doing their best to try to adjust for that, and they're coming up with new ways of getting data. Some of the data, like in the CPI, they're using private sector data now for some of that, and they'll be doing more and more of that as this goes on, because the government certainly doesn't have the money to do a complete rewrite of all its surveys.
When we hear from Jay Powell today, do you expect anything different given the fact that we have an upside surprise of ADP, we had ISM picking up? There's some smaller data points that he can talk to that we didn't have when he spoke on Friday.
Well, really, the data points we have are in the labor area, and he hasn't been concerned about the labor market. He's been talking about a strong labor market as one of the reasons why the Fed might stay on hold longer. And so this sort of just reinforces his message. The only real thing he said about the labor market is if the labor market collapses, then we would consider cutting right away. But that doesn't appear to be likely at this point.
Mike McKee breaking down the economic data. Yields creeping just a little bit higher, again at the long end of the curve and the front end as well, by 2 basis points, back through 470 on a 2-year. Work your way further out along the curve. A 10-year maturity just short of 440 at the moment. Yields higher by 3 or 4 basis points there. Clean break of 450 yesterday on a 30-year. Again today by about 3 or 4 basis points. Steve Weiniger Citi still alongside us. Steve, let's talk about the jobs data we just got, the ADP report, and the data we got earlier this week, ISM manufacturing as well. Steve,
Right.
Lisa's bringing up the right question, I think. Data dependency. What data should we be dependent on and shouldn't be? Steve, how much weight would you put on manufacturing earlier this week?
Well, look, I think it's been, useful data. We've been looking at a manufacturing sector that's been going through a correction, that's been depressed relative to demand. It's been, in fact, in a recession for the last year and a half, a mild one, but around the world. Now, that's not terribly relevant to the U.S. It's quite relevant to Germany. It's quite relevant to China. Now, there are other things that are going on in those places as well. But coming out of that, again, is very hopeful for the longevity of the expansion. Now, again, what happens in services and what's going to happen in employment is really going to matter for us. It's going to matter for monetary policy, which is relevant for the world on the U.S. side. We did 184,000 jobs every month this year. That would just be wonderful. We'd probably get a 2 rate cut year, but that would be great news, and it would be on the way to being a sustainable labor market. It's a lot closer than where it has been in the last couple of years.
So, Steve, it sounds like you do take some real signal from the non-farm payrolls report that we're going to get on Friday. Which aspect is it? Is it the headline number, as you mentioned, or are you looking at wages to see how much that stickiness really is present?
Well, it's all of these things. It's getting an impression from the sample-based data that you talked about. And it's putting it together over multiple months. The revisions are sometimes, as relevant for how we look at the data compared to just the headline numbers, whether they beat the consensus. Oh, well, fold in the revisions. The compensation data is interesting, but we have to take a look. Are there any big mix shifts? Are we going, are we doing it on the strength of retail hiring, or are we doing it, on IT services? You'll see different compensation numbers there. I'd say that the employment cost index, again, sort of a same-store sales measure of employment pressures, has come down, even without a collapse in the labor market. With a very, very minuscule rise in the unemployment rate, we've seen, compensation pressures moderate. And, I think if we could stay on that track and have monetary policy just moderate, again, come off of a very, very tight level that the yield curve is telling us, then we will be in a great place for making this a long expansion. That's what's really going to help financial markets and the public at large.
Steve, constructive. It's great to hear from you. Steve Whiting there of Citi on this equity market. If you are just joining us, allow us to set the stage for you just quickly. The economic data came out just moments ago, about 10 minutes ago, the ADP report. Big upside surprise there, 184,000. The estimate was 150. This is going into payrolls Friday. The median estimate in our survey at the moment, and as we've said repeatedly all through the week, and over the last few years as well, it's a moving target. You'll get more estimates going into Friday. But that's been going higher over the last few days, from about 200K to start the week to about 214 now. The previous number, 275. It's actually shaping up to be a really interesting session again. If you just get to the commodity market and take a look at what's happening with crude, Brent crude getting closer and closer to 90. It's up by about 0.8% on the session, 89.70. That move in crude, in comparison, may be in a relationship at the moment with what's developing in the bond market. Yields higher again by 4 or 5 basis points, Lisa. The 10-year getting closer and closer to 440, just as crude gets closer and closer to 90.
And the 2-year now at almost 472, really climbing higher as we look at this. Is it the data, or is it just the mush that people are putting together, then sort of add in some sentiment and some questions around what the thesis is? To me, honestly, that's the question. Are people trading on ADP, or is it something else?
It's ADP for 5 minutes, isn't it? And they sort of get over it, and then it's something else. Can I say all the above?
Yeah, please.
All of the above. Coming up next on this programme, former House Majority Leader Eric Cantor on the US deficit and a whole lot more. It's shaping up to be a very interesting Q2, just 3 days into the quarter. From New York City, you're watching Bloomberg Surveillance. 60 minutes away from the opening bell, equity futures pulling back just a touch by 0.2% on the S&P 500. We had the ADP jobs report out just moments ago. Came in at a punchy 184. Got no idea what that's worth for Friday. Upside surprise, the estimate 150. Friday payrolls, the estimate 214. So equities pulling back just a touch. Yields breaking out again. Let's switch up the board and get to the bond market. The 10-year higher by close to 5 basis points, getting closer and closer to 440. We've only had 3 days of Q2. We ended Q1 at 420. So we're talking about close to a 20 basis point move, at least in just 3 sessions.
And it comes as all of the data, and you can challenge each point, but they're all kind of coming to the conclusion that this economy is robust. Mike McKee, before he left, pointed to one data point in the ADP report about job changers actually seeing their wages increase by more than 7%. That, I think, is giving people pause. There is a stickiness and a sort of demand for workers that is persistent in an economy that is not slowing as much as people expected.
The commodity market appears to be at the epicenter of a lot of what we're seeing develop over the last few days. So let's turn to crude. getting closer and closer to 90. 89.71, positive by 0.9%. Annmarie, we heard from OPEC Plus a little bit earlier this morning, and they seem pretty happy with how things are developing.
Yep, steady as it goes. They're going to continue to ratchet back that supply, not adding any more. They're also going to go after the cheaters and try to get them in line to make sure they are hitting the correct quotas. Yesterday was really about geopolitical risk. Today was about supply when it comes to the oil market, and you heard that from Ed Morse, similar to what we heard yesterday from Amrita Sen.
Crude up, bond yields higher. We need to talk about the deficit in America. Citadel's Ken Griffin joining a chorus of CEOs expressing concern about the growing U.S. deficit, writing in a letter to investors, quote, "We must stop borrowing at the expense of future generations." His comments coming on the heels of BlackRock CEO Larry Fink warning, quote, "The situation is more urgent than I can ever remember. There's a bad scenario where the American economy starts looking like Japan's in the late 90s and early 2000s. In its latest projections, the CBO warning U.S. government debt is on a path from 97% of GDP last year to 116% by 24, higher even than in World War II. Eric Cantor joins us now, the former House Majority Leader and Vice Chair of Moelis & Company. Eric, good to see you, sir.
Good to be here.
We're all trying to figure out how close are we to a point where a leader in America comes out with a set of policies and this market rejects it. How close are we to that moment?
You know, John, it is so reminiscent of the discussion that we had even when I was on the Hill. And if you look back even 10 years ago, we were screaming the same thing, that we have reached a point of unsustainable debt levels. We have to do something about it. And I certainly agree with what both Ken Griffin and Larry Fink have said, that we are on an unsustainable path. I think, though, that the discussion around the debt and deficit is a little bit too simplistic because, yes, it's okay to have some level of debt and deficit. I think most people in their lives have it, and I think the government's the same. I think the trouble you get into is when you start growing that deficit and the debt more quickly than you grow the economy. And there is no agreement, though, on what to do about this. And so if the parties would sort of step back and focus on growing the economy, the decisions to correct the situation would be a little bit easier, the political cost a little less, if people could just try and focus on how we're growing the economy instead of a lot of the policy that's underway in Washington.
Isn't that the argument that the former administration led by President Donald Trump essentially made? That we can pile on more debt, but ultimately we're going to do it because we're pro-growth. Did that work out well?
No, because you've got to address both. I mean, there's no question that it is the demographics in our country and the healthcare costs and the increase in those healthcare costs turbocharged now with higher interest rates. That's where this is this trifecta of a really toxic mix that we've got that is threatening, I think, the future. And I don't know if we're going to see the two candidates for president, the incumbent, and Donald Trump, ever propose a fix to this. But I think we know how to do it. We talked about how to do it when I was there.
It's interesting that you have both sides of this. You have from the policy perspective when you were in Congress, and you have now from the Wall Street perspective when you're deciding how to invest and where to allocate. How convinced are you that this time is different, that the bond market is going to wake up to the risks that you see from the fiscal side?
Well, listen, I think on the deal-making side at Moelis, I mean, what we're seeing is clients who really reacted over the last couple of years to this volatility and uncertainty around interest rates. Obviously, interest rates, when you're in the deal-making business, are very, very impactful. So, I do think, at some point, the market is going to reject this continued incurrence of debt. I mean, we're spending $1.7 trillion more of money than we have every single year at some point. But again, I always go back to the fact that we're, quote unquote, the fastest kid on the block in this country. Where else are you going to put your money? And whether we're seeing signs of that now in diversification, I'm not sure yet. I'm not sure, because when I look at it and you look at the ADP report out today, we'll get the jobs report out later this week. But, where else is there this innovation and dynamism? I mean, we're on a roll in this country where you've got more small business startups than we've ever had before. That is a signal that people are optimistic about America.
If the market, though, was to push Washington's hand, because Washington is not going to be the ones to come up with a plan for the fiscal deficit, are the right people in place? You had a great relationship in 2011 with then former Vice President Biden. He's spoken glowingly about you, able to work in a bipartisan fashion. Are the right people in place to actually come to the crisis?
Look, I think that the situation will demand that people, step up and come up with a solution. And there's really, to me, if you want to fix the problem and send the signal to the markets that the country and the investors in the markets that the country is on the right path, it's a simple notion, but it's difficult politically. You just take the steps to change the healthcare entitlement, the Medicare program, from a defined benefit system to a defined contribution, and basically offlay some of the risk to the beneficiaries. That's really, really tough politically. But if there were a crisis, if the markets did reject what's going on in Washington, you could take more interim steps to go in and tweak the age of retirement, to reduce the indexing of benefits. You could means test. There are some things where you could buy, and the government could buy us a decade plus in terms of the viability of these programs.
That just doesn't win elections. I want to talk about some of the proposals we are hearing from the candidates. Former President Donald Trump is talking about 10% tariffs, a wall, and then 60% blanket tariffs on China. We ran the numbers, and that says PCE will be north of 3% yet again. Yeah. Do you think he would actually do that, given the fact that this can mean such higher inflation, especially on everyday Americans?
Well, I think it goes back to that admonition that someone had given back in 2016, don't take him literally, take him figuratively. Who knows? Who knows what we can expect? I think the unpredictability is what he likes. And there's no question that his message is we have been taken advantage of by others, in particular China, and we need to step up and gain some leverage when we try and negotiate some resolution of this situation. But listen, there are very troubling signs coming out of China, separate and apart from the national security concerns around particularly sensitive industries. Because you think about what's going on with EVs and the fact that the Chinese government is well aware they've got to do something to take care of their domestic economy. So they are ramping up production in their manufacturing sector. And guess what? They're going to have so much excess that now they're already looking like they're sort of dumping all those into Europe. And the EV situation, very, very concerning. And our OEMs here are equally, I think, as concerned that that may happen.
When it comes to a deal-making perspective, how much are you avoiding cross-border deals because of some of these questions and concerns?
Well, I think it's very interesting because so much of the sectors that investors will look to, really, we're shining in the U.S., and there's a lot of European, Asian, Middle East investors who are looking to allocate their capital here in the U.S. But, of course, there are political ramifications to monies coming in, and we've seen that when it comes to countries that are not aligned with us, whether it's China or someone else who is just not on the favored list. You have to go through the hoops with CFIUS and things like that. But I think the real concern that, I continue to hear from clients at Moelis and others is the fact that we've got a situation with our antitrust regulators that it's not just applicable to cross-border deals, it's applicable to every deal. And I think what Lena Khan, Jonathan Kanter have done at both FTC and DOJ has been such a stretch in terms of interpreting the law and the antitrust law. And they've, I think, done a disservice to our country, to investors, and frankly damaging the competitiveness of America as a destination for capital.
That's the world we live in right now. We were talking to Brian Moynihan just the other week on the trading floor of Bank of America. Had a similar complaint. He was talking about the amount of deals that were being held back by the prospect of them just not being able to pass, not being able to go through. And no one wanted to be on the wrong side of that, being left to hang out to dry for a year without any idea of whether the deal will close or not. Are you seeing the same thing? Potential deals that could close that just aren't being made right now?
I do think, and what I will say to decision makers is that, if we're going to go forward, if there's going to be a deal to work, we're going to have to make sure that we allocate the necessary time, resources, and commitment to get through that process. But think about it. If we like to be the location in the world where capital flows to its most efficient use, where it's the most dynamic economy, velocity of capital, we shouldn't have to do this. And unfortunately, there is just an overwhelming ideology that's infecting the policy in the current administration in Washington that is not necessarily that favorable. But again, all the while you look to and say, where else? Or is it any better?
Let me ask you this, though. Is that ideology infecting both parties? Because right on cue, deal crosses the Bloomberg terminal, we announce it, we talk about it, we go to the Twitter account of the Senator of Massachusetts, tweet, shock. Not surprised at all. What is surprising is the amount of Republicans that agree with her now. That's a shift. And I'm trying to work out, do we actually have a business-friendly party in Washington anymore? Does one exist?
Listen, I always like to say I'm a limited government, pro-free market, pro-national security, conservative Republican. But I agree, Jonathan, with your sentiment that Donald Trump has changed the nature of the Republican Party. We are, I believe now, perceived as the working class party. And the Democratic Party has done more to ingratiate itself with, quote unquote, the elite and the very far left on the ideological spectrum. And somehow the extremes are meeting. And you're seeing this happen. And I worry about this because this extreme push in terms of government role in the economy has happened with the support of both parties. You look at the IRA bill, certainly that was one party, that was the Democratic Party. But if you look at the CHIPS bill, look what that did. I mean, that was industrial policy focused on a particular industry that folks in my party decided was a good thing for national security, so let's let the government go all in. That is not sort of the limited government outlook that you see. And so you're right, there is a shift towards labor. Labor is in the polling, public polling in this country at an all-time high in terms of favorability. And both parties, you've seen it. How in the world can a White House go and join the picket lines? That's what President Biden did. But you know what? So did Donald Trump. So did several Republican senators join the picket lines in Detroit.
Well, to Jonathan's point, J.D. Vance, who is a VP shortlist candidate, literally came out and said he thinks Lina Khan is maybe the only effective person in the Biden administration. So say it was to be Trump. Are you getting the same sort of DOJ, same sort of FTC?
That's the real question as to whether we're going to continue to see the extremity. I don't buy that because I still think there is a DNA.
You're a product of that extremity. You lost your seat because of that. And that populist wave that people said, you were really the beginning of it.
But remember where the anger was. The anger really was against the so-called establishment. It wasn't necessarily towards it was towards everything. We thought and probably assigned an weight to the import of profligate spending in Washington. I think it was just more, it is about the establishment, the system, et cetera. I don't necessarily think people are going to the polls in November based on antitrust regulation. I really don't. So I think that where you're going to have manifest in a next Republican Trump administration is more of the DNA that's a little bit more balanced and not so punitive on corporates.
People might not be going to the polls, but you have to plan a business around it. And that's really one of the key questions. And we keep getting people in here saying, Lori Calvasina, it's like staring at the sun. How do you plan for something that feels like it is shifting and you don't know exactly how? Is there any way that you are planning with the business and the deal making to get ahead of whatever kind of push we're going to get in November?
So I just think that we've got to be very mindful. In 2025, there will be the Super Bowl of fiscal policy debate because you've got expiration of the Trump tax cuts. And some would say, well, not all of them. Well, yes, there will be. Everything will be on the table. In just to extend the lower, the $400,000 and under income bracket, that's a $3.2 trillion issue. You talk about the debt, fiscal year 23, we were at $791 billion of interest cost, and we're going up. And so everything's going to be on the table. IRA, the subsidies. I would say if there's any anticipation and advice I would give for those who have been on the uptake in terms of these subsidies with the IRA, especially as it relates to EVs and the renewable industries, we better take a real look to see whether we think those will continue because they're going to be on the table too. I believe my party will first up look at some of those subsidies and get rid of them.
So final question for you, trying to work this all out, because I think this is really, really difficult. In 2016, we had a candidate, and I think if you could divorce the person from the policy you looked at was pro-business, low taxes, confrontation at some point with China. And then TikTok happened in the last couple of weeks, and I was just thinking, is the Trump template from Volume 1 applicable to Volume 2? Do you think it is?
I do. I don't think that he has changed much in terms of his career trajectory. He's always been anti-China. He's always tried to go and gain some leverage in negotiations. He's a deal maker. I also think that he is focus on a growing economy. I think at the end of the day, with all the noise you see from J.D. Vance coming together with Elizabeth Warren and what have you, at the end of the day, the Trump administration next time will be pro-business because he'll want to see a growing economy.
I could talk to you all day. This was great. Let's do it again soon.
Terrific.
Eric, thank you. Eric Cantor there of Moelis. Let's get you an update on stories elsewhere just briefly with your Bloomberg brief. Here is Yahara Hakez. Hey, Yahara.
Hi, John. Endeavor Group, the controlling investor in WWE and the Ultimate Fighting Championship, has agreed to be acquired by private equity firm Silver Lake. The $13 billion buyout follows through on plans announced back in October. Endeavor said at the time it was evaluating strategic options out of frustration with the company's declining stock price. Disney holds its annual shareholder meeting today, and Bloomberg can now report the company is poised to win enough shareholder votes to defeat a challenge against its board mounted by activist investor Nelson Peltz. Elon Musk weighing in, saying that while he doesn't own any Disney shares today, he would definitely buy if Peltz was elected to the company's board. President Biden and former President Trump both added to their delegate counts last night. 4 more states held primaries on Tuesday, and the presumptive nominees easily won in New York, Connecticut, Rhode Island, and Wisconsin. Trump picked up 78 to 84% of the Republican votes, while Biden took 83 to 91.5% on the Democratic side. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, a wake-up call for chip makers.
What's very interesting here is that it's another big wake-up call for us, which is like we all rely on farms that are selling in Taiwan, and the situation could have been much, much worse, and we could have lost production capacity.
That conversation up next, live from New York City. This is Bloomberg. We're counting you down to the opening bell, about 41 minutes away. Equity futures negative by 0.2%. Yields creeping higher by 4 basis points, closer to 440, closer to 90 on Brent Crude today. Brent Crude at the moment higher by about 0.75%, 89.60. Under surveillance this morning, it's a wake-up call for chip makers.
What's very interesting here is that it's another big wake-up call for us, which is like we all rely on farms that are selling in Taiwan, and the situation could have been much, much worse, and we could have lost production capacity. And if we are losing production capacity, we would be back into an after-COVID kind of situation where the whole economy is, struggling to find chips.
Here's the latest this morning. Hundreds are injured and at least 9 are dead after Taiwan's strongest earthquake in 25 years. Flagship chipmaker Taiwan Semiconductor is moving some staff out of facilities and is assessing the impact and the potential for aftershocks. Taiwan is the source of approximately 80 to 90% of the world's highest-end chips. Mandeep Singh, senior technology analyst for Bloomberg Intelligence, joins us now for more. Mandeep, Taiwan Semi is down about 1.6%. I think we're all trying to figure out here at Bloomberg just what damage has been done. What damage has been done so far?
I mean, obviously, it's a tragic event, and clearly we don't know the extent of the shutdowns or if there have been any, leakages, gases. There's a lot that goes into, manufacturing semis, and it's a pretty complicated setup. So we don't know the extent of, the damage, but what we know is clearly there's been some loss of lives. And I think when it comes to factories, I would imagine there is a temporary shutdown, and we'll find out exactly how much impact it will have on the production.
We have to wait for exactly how much it has been. But what could the impact be? What would that materially mean?
Well, so think of, some of these manufacturing nodes are like 3-5 nanometer. That requires a lot of, talented people to show up at these factories, as well as in terms of the setup. We're talking about really, complicated things in terms of how, as I said, there's a lot of gases that goes into manufacturing these semiconductors. And I think clearly there will be a level of disruption, but the leading nodes is where all the focus is, because that's what all these companies rely on. At the end of the day, they are the primary factory for manufacturing the leading node chips.
The parallel here of what's going on with the possible disruption at Taiwan Semiconductor Manufacturing Company and then Intel reporting widening losses at their foundry just highlights how difficult it is, the barrier to entry, to really diversify some of the output of these chips. Can you give us a sense of why it has been so difficult to move production to places like Japan, like the U.S., to try to insulate from potential supply shocks?
Yeah, I mean, look, I think Intel said they will lose about $7 billion in foundry operations. So that just goes to show that, they are investing a lot of capex upfront to bring the leading node manufacturing in the U.S. But what it requires is not only the setup with the EUV machines, but also the components and all the parts that goes into manufacturing semis and the talent. I mean, one of the reasons why it's been so hard to relocate the supply chains out of Taiwan is because you don't have the availability of talent elsewhere. And that, I think, is Intel's challenge as well, because they also go to TSMC to manufacture their latest 2 nanometer, 3 nanometer chips. So that just tells you that despite investing so much, they're still relying on TSMC.
Mandeep, you could write a book on this. Books have been written about this. If you had a map of the world and you wanted to pick the worst places to build these things, that's where they are. We'll get into another day why they're there. Just how long does it take to build replacements for them? And not just to build the physical plant, but to attract the talent as well.
Well, so I think it requires a lot of training. Some of what Intel is pitching to all the governments is, look, we are not only setting up fabs, we are training people. And that training would require, a few months, years for that matter, just to, train people in terms of how to use this equipment. So clearly, I think TSMC and Samsung, the other fab makers, are also opening up these plants. And they have plans to, do manufacturing in the U.S., but they will run into the same sort of issues. At the end of the day, you need to train people, and that requires time. There is no capex, kind of immediate capex that you can use to train people.
Is there effectively then no substitute?
Well, as of now, I think if you're looking 12 months out, there is none. And if something were to happen in this case with the earthquake, clearly things will come to a standstill in terms of leading node manufacturing. I think 3 years from now, 5 years from now, Intel gave a 2030 forecast where they expect Intel Foundry gross margins to be 40%. Now, that's a dream scenario. Right now, they're bleeding money. It's negative gross margins. So that just goes to show there's a lot of hope in terms of what can be accomplished. But I think a lot needs to be executed upon.
Mandeep, thank you, sir. A difficult moment in Taiwan. Mandeep Singh there of Bloomberg Intelligence. Coming up tomorrow, this is what the lineup looks like. John Stolfus of Oppenheimer Asset Management, very bullish. We'll catch up with the Israeli economy minister as well. Jean Bavan of BlackRock and Becky Frankiewicz of Manpower Group on a big week for labour market data. Earlier on this hour, we had the ADP jobs report. That came in, Bramo, at 184, the estimate 150.
And the highlight, and Michael McKee pointed to this before he left, but the fact that job changer wages surged 10% in that survey has the attention of many people in the market, including Ian Lingen of BMO Capital Markets, saying maybe this suggests more heat under the surface than people had previously expected.
The next stop for this market, 10 a.m. Eastern Time. The ISM services read Q2 starting with a bit of a bang after what we saw with the ISM manufacturing read on Monday. Then it's on to Chairman Powell later on this afternoon. Tomorrow, it's on to jobless claims, and then it's on to payrolls Friday. Your equity market going into the opening bell shaping up as follows. About 34 minutes away from the cash open, with equity futures on the S&P slightly negative. We're down 0.2%, and bond yields higher by 5 basis points. Your 10-year 4.3952, and crude 86, very, very close. In sight, $90 on Brent from New York City. This was Bloomberg Surveillance.